Look, assuming there's no news, which is a horrendous assumption, the trend should be for the market to drift higher. But as we know, as we saw the last time we talked, there is news and it does affect the markets. So pay attention. But all things considered, we expect an upward trend into year end.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back at the end of the week for another weekly market recap, this time featuring my good friend, Michael Lebowitz, portfolio manager at RIA. Michael, how you doing?
I'm doing great. It's Friday.
It's
Love to be
Friday.
here.
Well, it's funny you mentioned that. So the last time you were on, Michael, which I think was 2 weeks ago, we had to record on a Thursday because of my schedule. I had travel. And I made sort of an offhand comment of, hey, folks, we're recording this on Thursday, so we're going to be missing one day of the week. Hopefully nothing happens in that last day. And then, of course, the markets had like their worst down day of the year. So glad we're
Right.
doing it on Friday again.
Well, so what's going to happen on Saturday now?
Yeah, I know. Well, let's not tempt fate there. But what was interesting is the markets did have a big drawdown for a brief moment there. There was a lot of panic and kind of a lot of volatility over the next couple of trading days because it was a on again, off again tweet trade war between President Trump and the Chinese. Um, we'll get more to that in a moment. But since that uncertainty in the markets, they've picked themselves back up as they've been doing pretty much all year, and pretty much trading back at record highs on the day we're talking here. So I think maybe Michael, maybe we just go straight to the TA here. Um, Market seems to be feeling pretty good right now, despite all the potential negativity we've seen in the headlines recently. What's your take here?
Yeah, and if you remind me, let's get back to that Friday from 2 Fridays ago, because there was a little liquidity issue, and liquidity issues are starting to pop up a little. So I would like to expand a little bit on that, but we can do that a little bit later. Let me share my screen, and we're going to start with a graph of the S&P 500. Um, Not much has changed. We've talked about this divergence between the MACD, which is just slowly leaking lower, and the market, which is, for lack of a better word, slowly leaking higher. Um, and same with the RSI, which is down here in the red. It's, lower highs, lower lows. Kind of same with the MACD. The MACD is going on a little bit of a buy signal, but it's been doing that back and forth buy sell signals as it declines. So it is working towards fair value, which is positive. The RSI is close to 50, which is fair value. And you can see the S&P has kind of gone nowhere for a month and a half. Um, the moving averages have proven to be helpful. Right now, the last couple days, we've been supported by the 20-day moving average in red. The blue is the 50-day, and that did provide initial support. Um, but right now, that's kind of, if we break the 20, that's the next line in the sand. And then I just drew this red line. It's been a line of support pretty close to the 50-day moving average. So that's a level to watch. We don't want to break that because then you set a precedent of a lower low. Doesn't mean it's the end of the world, but something to pay attention to. Conversely, if you get above the green line, you hit record high, higher highs. So let's see how it breaks out of this range. The market's trading decently this morning, bringing it to the very upper end of that range, but not quite at a record high. Um, we'll see. And then at the very bottom, I added on balance volume. That may be a new one. And it's basically measuring on, if it's an up day or down day and what the volume was like. And generally, in a bullish market, you want to see it trending upward. What we don't want to see is it start to flatline or even decline while the market's going higher. That's telling you that the selling pressure is increasing, even if it doesn't show up in the S&P itself. So it's another technical indicator that we can pay attention to. In 1999, that was one of the hints that there was something changing in the structure of the market that had flattened out despite the market going on to record high after record high. So something to watch. There's zero warning. It's doing exactly what you want it to do. And, as we kind of look ahead, we have a big week in earnings. A lot of the big tech companies are next week, along with a lot of other large companies. And we're slowly, once we get past that, we're getting on the other side of earnings season, meaning that A, a lot of the earnings news is now in the market, but B, a lot of these companies in stock buyback blackout periods can start buying back their stock. And that starts as early as this week. Some of the banks have reported already are probably out of the blackouts. Companies that reported this week could probably start buying back next week. So you have that support for the market that starts kind of coming back into the market that was left out for the last few weeks. And then we just run into the holiday cheer, the rebalancing, the typical year-end activities that traditionally are helpful to the market. So, you
The
know,
Santa Claus rally.
the Santa Claus rally. Look, assuming there's no news, which is a horrendous assumption, the trend should be for the market to drift higher. But as we know, as we saw the last time we talked, there is news and it does affect the markets. So pay attention. But all things considered, we expect an upward trend into year end.
Okay, so I had some folks on the channel not that long ago, like Mark Newton, who is Tom Lee's research partner at Fundstrat.
Mhm.
Fundstrat famous for being very bullish most of the time. And Mark is a technician's technician. I mean, he's like, look, I don't really care I don't really listen to what Tom Lee is saying. I just look at what the tape is telling me. And
Mhm.
even he was saying, all right, I've got some near-term concerns that the market could pull back a bit in October, November. I think he was saying this around the beginning of October, and then said, but I expect that to be a buying opportunity, and then the year to end strong. Typical end of the year rally. I've mentioned this to Lance. I think Lance has said, yeah, that sounds pretty right to me as well. So looking at where we are right now, with the best data you have available to you, which is always imperfect, do you think we're beyond whatever pullback risk there was in the market, and now we're just going to kind of drift higher until we get to that goosing of the Santa Claus rally, or do you see signs that we might not be out of this yet? November might actually still see a downdraft.
I struggle with some of that a little bit because I think some of that sentiment I know from Lance and maybe Mark is based on history, and Octobers have been among the worst months. Um, but there have been plenty of good. I mean, Octobers have been among the worst month, but there have been plenty of good Octobers. So I think it goes back to the question is what could upset the apple cart? And I could rattle off 40 things that could upset the market any month, any day. Um, and President Trump is very vocal, and he's always willing to say something that can stir the pot, both positively and negatively. So obviously, something can happen. Something can happen late November, early December, January. Obviously, I'm not ruling anything out, but I don't. There's nothing I really see that is predictable that is really going to cause the market to change direction rapidly. Not to say we don't get back down to the even the 50-day moving average as support, certainly, but um, there's really not much right now. Doesn't mean my long-term outlook is this bull market's going to run forever, but I do think the market is pretty supportive from here to year end.
Okay. All right. Well, look, some of the data that is lifting stocks today, Friday we're talking, is the latest CPI data came out, and I'm not fully versed in exactly which research functions are shut down during this government shutdown and which aren't, but we did get a new CPI update. Um, it came in as quote unquote cool, meaning it was a little bit less than expectations, both month over month or year over year. It is notable though that the year over year CPI number was 3%, which I think is the highest since January. So inflation is still kind of remaining sticky at the 3% level, but it wasn't as much as what expectations were. So people are interpreting that, it seems, as okay, well, this gives the Fed, more room to cut. This inflation is not so hot that it might slow down the rate cut. So the market's saying, okay, good, rate cut's still on. Maybe even we get a little bit more. We'll see. Um, Anything else to say about this new inflation data?
I I know the stocks are up decently this morning. Bond market has really done not much. It's up a hair or down a little bit in yield. I just don't think the market read too much into it. The data is stale. It's who knows how accurate it is. My guess is this number could be revised decently. We just don't know how they're reporting it. Are they doing the same calculations they were doing using the same amount of data? There's a lot we don't know. So I think as long as it came in a tenth above or below, it came in below, but a tenth within expectations, the market wasn't really gonna care about the number. Why the stock market's going up today? I don't know. It goes up almost every day. But I think the bond market is kind of the tell that the market just doesn't care. Um, the one aspect of it, and we've talked about this for a while, is that CPI shelter prices are coming down. And that's one reason why the number came in slightly better than expectations. That's going to continue to
Right.
happen for a while, not just months, many, many months. So it's just playing catch up. So, I think in the media, you're going to see some argue, well, the inflation is not as good as they say because some of that was shelter. I would argue the opposite. Inflation is too high already. The real inflation rate is lower, but shelter is keeping it higher, and we're in the process of normalization. Now, again, Adam, we can debate all day what the right inflation rate is. I'm just talking about the CPI inflation rate,
Yep.
right? You can argue it's 5%. And look, when I go shopping, I'm not going to argue with that. It certainly seems like it's pretty high, but CPI is what drives the market and what drives both the bond and stock market, gold market, every market. So, that's where we have to talk.
Yeah, and as you have said many times, and the math makes total sense, is that of that official CPI number, 40+% of it is shelter. It's the big dog in the calculation, and that seems to be disinflating, and that is just going to be dragging the CPI down, or at least a large part of the CPI down with it, as you said, over many, many months from now. So,
Yeah, and in fact, so rent is a part of that. Um, and the Cleveland Fed. So the one of the big reasons why it lags is because what they're doing is they're doing surveys and they're asking people what their rent is this month versus last month. So if you signed a lease a year ago or 6 months ago, your rent this month is the same as it was last month, as the same as it was the month before. It's only till you re-sign your lease that you have a new rent and it gets captured. So they are capturing some new leases, but they're capturing a lot of old leases. The Cleveland Fed has an index where it's just new leases, whether it's renewals or new people, someone moving
yep,
into a new apartment or house or whatever it is. And that index actually has been plummeting,
right,
going well below zero. So, and that jibes to some degree with what we're seeing from like apartment.com and some other private enterprises that do this for a living. They're not plummeting as much as the index, but they are in negative or flat to negative territory. So that tells me that what we're seeing with CPI shelter today is probably going to go on for another year, year and a half. Regardless of rents could start spiking tomorrow, but for that same reason, it's going to take a while, a long while to get into CPI.
right. It's a
You know,
very
it,
lagging indicator in CPI.
a very flawed way of calculating it as well. We don't do that with anything else. We don't say, what did you pay for gas 6 months ago?
Right.
Right? We asked you, what's the price of gas today?
Yeah. Yeah. So I had housing expert Nick Jurley on the program recently, and he walked through the rent data, and his data sources show the same thing, Michael, that rents are deflating at this point in time.
Right,
And a factor of that, it's not the only factor. We're seeing all sorts of potential weakness in just the general consumer household. But a decent factor in it has been the clampdown on illegal immigration and the deportations. Um, so the millions of illegal aliens that were coming in here, they weren't really pushing up the prices of housing very much. It's not like they were crossing the border and then outbidding a regular American for a house. But
right.
these guys got to live somewhere, right?
Hmm.
And yes, some of them were being put up in hotels, but a bunch of them were, living together and renting someplace, right? And so, especially in the areas that had high populations of illegal immigrants, they've seen really strong rent deflation. And, obviously, rents go down in one part of the market. Well, that makes it attractive for people who might rent in the other part of the market to say, well, I think I'll start renting there. So it starts pulling rents down everywhere, right? And
Right.
because in theory, a house is worth what you could rent it out for, that actually does indirectly begin to impact housing prices as well. So we have a bunch of factors that are impacting the housing market right now, including a lot of inventory coming onto the market finally. But this is one of
Yeah.
those elements, which is declining rents are starting to actually really weigh on home prices.
And look, I know you have a couple housing experts that know a lot more than me about housing. But my take on housing is that there is a lot of pent-up supply, a lot of people that want to move but can't because mortgage rates are too high and they don't want to turn in their 3% mortgage for a 6, 7% mortgage. It just doesn't make sense. So there's a lot of pent-up supply, and couple that with the demographics. There's a lot of baby boomers that are retiring, close to retiring, want to retire, that would like to downsize or move to a warmer climate or whatever it may be. So there's a lot of pent up supply, but I also think there's some pent up demand because of mortgage rates, because of high prices. Buyers haven't been willing to buy, they've been renting. So I think the big question for the housing market is how big is that pent up supply and demand? And are they the same size and will everything just kind of be steady or is one bigger than the other? My gut tells me that the supply side could be bigger than the demand side, especially with the labor market weakening as of late, that a lot of people may not want to commit to a house at this point, even if rates come down. They're going to need for prices to come down too. But, your experts know more than me about the housing market, but that is a concern I have.
Well, they agree with your gut. They're actually getting quite worried that demand is really what is falling here. So it's almost irregardless of what happens on the supply side, which is increasing. They're saying the big problem is there's just not nearly enough demand there right now, at least
Right.
for what the sellers want. Um, I also want to put up this data that Lance Lambert, another housing expert, he runs ResiPro.
Mhm.
The Mortgage Bankers Association's updated forecast for the average 30-year fixed mortgage rate. So he's got it by quarter for the next 2 years. Well, it's 6.4% in Q1 of 2026, for all of 2026, and then 6.3 for all of 2027. So I look at that and think, all right, that helps a little bit, but like that's not the cavalry that everybody's hoping for on the mortgage market here, right? If you're one of
Yeah.
those people that's stuck because you've got a sub 3% mortgage, a 6.3% mortgage 2 years from now is not really going to make housing that much more attractive to you.
No, I think backing into his forecast, what he's telling you is the economy is going to be mediocre and yields are going to stay exactly the same for 2 years. Treasury yields, which will basically keep mortgage yields about the same. He's not forecasting an economic boom. He's not forecasting a recession. So,
Yeah, and by the way, that's not his forecast. That's the Mortgage Bankers
right.
Association.
No, I know.
Yeah,
No, I know. It's the safe forecast. Right? If that was my job, that's what I would forecast too, because you're not going to hurt anyone's feelings. But if you think we're going to have a recession, odds are that mortgage rates fall quicker than that, much more so than that.
sure.
And if you think we're just in the first inning of this massive AI boom, and the economy is just going to go gangbusters, they could be decently higher.
All right.
So,
Well,
so
again,
they're not going out on a limb, is what I'm telling you.
they're not going out. I totally get that. And that's, like as you said, it's probably their job, but they're also not going out there and saying, hey, we see mortgage rates coming down to the 4%, and that's going to really, unlock this market and make it affordable for those people to finally move, downsize, whatever, if you're a senior sitting on a 3% mortgage.
Well, here's the tough part with that. If we get down at a 3-4% mortgages, we're probably in a recession. So then the question is, who can move?
Right.
Can people afford to move or feel comfortable buying or selling? And that adds a whole different factor to the equation.
Well, and so this is why so many of the housing experts I talk to, and again, my own personal opinion for what it's worth, is mortgage rates stay the same. What's going to make housing more affordable, which it needs to be to move all this inventory that's coming online, is it's not the rate, it's the price. Price is going to have to come down.
Hmm.
To your point, okay, let's say the mortgage rate does drop into the fours, in the next year or two. Well, that's probably because we're falling into a recession. And what else is going to have to come down to make housing affordable? Price. So it's kind of like, under most scenarios, it's like the thing that's going to have to clear this market is price. And we're already seeing that right now in the new housing market, right? Which we're in this weird aberrant moment right now where it's actually cheaper to buy a new home than it is to buy an existing home. And the main reason for that is to move the inventory. The home builders are having to provide all sorts of cash and non-cash discounts.
Right. I mean, I see it in my neighborhood. Houses are just sitting there, and they're good houses. These houses half the time would be sold the day of the open house, the first open house, if not before. They're sitting there for months. Like a couple of them have been on for almost a year. There's only a few houses in my neighborhood has maybe 2,000 houses. There's, you know, there's never more than 5 or 6 at a time. And they're just sitting there, whether it's the lower price or the higher price, it doesn't really seem to matter. So, I don't think, I think the market's just in a stalemate. It's just not moving. It's just sitting there. And you have these marginal transactions which affect these statistics, but I don't think they really tell the true story that house prices are either rising or falling. I think you need more volume to tell you a better story. So,
Well, so I think you're in one of those markets that's kind of in the Wile E. Coyote moment stage where gravity hasn't kicked in yet, but there are a lot of markets and an increasing number now where enough inventory has come online that gravity is taking over. I mean, God, you live in Austin or you live in St. Petersburg and you're familiar with what free fall looks like. But
yep.
talking to Nick Jurley, one of the things that really caught my attention was um, as of July, I think it's the most recent data he had, um, prices had fallen month over month in half of US states. And we're even starting to see weakness in places like Boston, some places in the Midwest, which were, up until now, people have been saying, well, these are bulletproof markets because there's just not enough inventory here, right? Even those markets are starting to see some real price softness now. So we'll see. But I mean, you live, if I understand correctly, you live close enough to DC that, you know, historically there's a lot of demand there. And maybe this movie is just taking a little bit longer to play out where you live.
But but keep in mind the government layoffs are probably the most in my area.
Yeah.
And the impact, people working in the private sector for companies that consult to the government or work for the government in some way are being impacted as well. So not nearly as bulletproof as it used to be. But, again, I would just characterize house pricing as kind of flat, probably leaking a little. But again, there's just not enough transactions to tell you what's going on because the price of every house is unique. It's not like new homes where they're identical. My neighborhood, every house is unique. They're all 80 years old. They've been knocked down. They've had additions. They've, done all kinds of remodels. So because one sells at a lower price doesn't, it's hard to, with used homes, it's harder to tell what's going on with price than new homes. But to your point, Case Shiller is telling us that home prices are flat to falling in decent parts of the country.
Yeah, yeah. Well, anyways, you're going to be an interesting bellwether here. So let's have this discussion again in Q1, and you can tell us what's going on there.
And just for the record, about 2 hours ago, I got a call I seem to get every few weeks. Are you interested in selling your house?
Really?
And I give them a number that's twice the value of my house, and they hang up on me. But someday I may be moving next door to you if they accept it.
Well, we'd love to have you here in Reno. All right. Well, look, lots of stuff to get through still, so let's keep going. So, I mentioned early on what caused the market volatility 2 weeks ago was the trade war back and forth between President Trump and China, and that's continued. So, we're still in the midst of that. That's a bit of uncertainty here. Again, market doesn't really seem to care about it at this point in time. We also saw the president just smack Canada because an ad was run in the province of Ontario that was sort of critical of tariffs, the U.S. tariff policy. And I mean, I'm sure this is just a negotiating tactic, but Trump, kind of threw his hands up and walked away from the table and said, okay, these talks are over, right? So we've got all that going on. Curious to hear if you have any thoughts one way or the other on that. Maybe it's just a whole bunch of Kabuki theater at this point in time. But before you answer, just one question related to this, which is, as part of the trade war hardball, President Trump has really been tightening the screws on a lot of countries, China included, to really cut down their purchasing of Russia oil. Trump is, touting himself as the peace president. To his credit, a lot of wars have ended under his 9-month-old administration so far. And coming off of the Israeli-Palestinian peace agreement, he's now really trying to zero in on the war in Ukraine. And Russia apparently has not been, has been dragging its heels more than Trump would like. And so he's really now trying to tighten the screws on them economically and pushing big countries to buy a lot less. And so China and India have basically agreed, we'll see if they follow through with it, but to really curtail their purchases of Russian oil and gas. So two questions on this. One, any thoughts on the whole trade war thing? And then on the pressure on Russia oil, we're seeing the U.S. oil prices, Brent prices, world prices start to tick up here. Is the bottom in oil in?
No, maybe. Let me go to the first one. I'm surprised the market even cares anymore about the tariff negotiations. We have seen this so many different times where Trump puts a tariff on a company, on a country, they retaliate, it gets worse. They play ball, it gets better. Then something happens, it gets worse. It's a game. It's a negotiating game that's being done in the public. And it's, again, how many every day is a Taco Tuesday. Every day is also a day where we get a new tariff or, something else going on. So I think it's important to pay attention to what's going on with the tariffs, where they ultimately end up. But watching a negotiation it's like watching an NBA basketball game and thinking because of one or two plays in a row, how the game's going to end. They're ultimately going to score 200 plus points. Those 4 points had very little to do with anything.
Yeah,
Um,
it's a good analogy.
yeah. What was the second part of that again?
Is the bottom in
Oil.
oil in?
You know what? If Russia comes to the table, Trump will ease the sanctions, oil goes back down the 5-6% it picked up over the last day or two. I think more of that equation has to do with the economy. If we go into a recession, oil could slip lower. But oil prices are decently cheap here. And we know that production is being cut back on the margin. And OPEC is increasing production. So let's see what the economy does. But oil will probably stick around where it is, go up and down with some of this Russian news. But I think it'll be more dependent on the US and global economy where it ultimately goes.
Okay, on that last point then, um, where do you see the economy going, let's say over the next 12 months? We had seen a lot of signs leading up into the shutdown that the economy was slowing, not crashing, but slowing. Um, I think some of those headwinds still exist, though I've had a number of people on the program of late, Barry Stale's name that immediately comes to mind, that says, hey, not only, is liquidity still going pretty well, but like we're going to start seeing tailwinds from a lot of the new administration's economic policies as we head into 2026, and that's going to keep things growing. So as best you can tell right now with the shutdown and the data we're not getting right now, where do you see the trajectory of the economy going?
I think parts of the economy are doing well. It's that K-shaped economy. Parts are doing well, parts aren't. I think it ultimately comes down to employment. Employment affects sentiment. Sentiment affects personal consumption, which is 70% of the economy. So if you know how consumers feel, are they scared and pulling back on spending, or are they optimistic and willing to spend more? Go, you know, want to go out to dinner an extra night a week or buy that couch they've been waiting for, a car, whatever it is. So I think the employment market will help answer that question as we go through. Um,
What's your default at RA right now as you look to 2026?
I think we slow down, but I don't see a recession necessarily. But I think we not slow down, but we kind of stay at this slow rate of growth, 2%, give or take. Uh, which, by the way, that's the natural growth rate of this country. So I know it seems low, and it's, over time, I think it just probably goes slightly lower over time. The Fed thinks, I believe their long-term estimate is 1.7, 1.8. Um, so we're basically at trend growth. We've erased all that, we finally, all that extra liquidity and momentum in the economy from the pandemic is finally out of the system, and we're back to trend growth. So again, if you tell me where employment will be for the next 6 months, I'll give you a much better indication of where the economy will be.
Okay. Well, we're not getting fresh employment data right now. And even when we were, a lot of people weren't really believing it, right? Do you have any indicators, hard or soft, right now that are telling you where employment's headed?
Yeah, so ADP has been pretty clear that the labor market is barely adding jobs. We can look at payroll taxes or tax withholding, uh, although I
Hmm.
guess that data is not being released. But prior to the government shutdown, that was telling us that we were basically not really adding jobs either. So, to the best of my ability with the limited data available, my guess is we're probably growing between 25 and 50,000 jobs a month, which is 100 plus thousand, 100,000 plus below where we should be growing given the growth rate in the economy. So that is a problem. But again, we don't have a lot of meaningful data, which maybe is good. Maybe it's good that we step back from this constant flow of data and really assess the economy on some of the more private sources. Um, it's actually been refreshing from my seat because the markets jump up and down because a number is a
Right,
tenth of a percent high or low. In the grand scheme of things, that number will be revised 6 different times and be something outlandish one way or another. No one cares. But, at the heat of the moment, it's that,
right.
some fraction of a percent that moves markets and creates narratives that are half the time not true.
Okay. So that's interesting. So it's just taking some of the noise out of the system.
Yeah.
Yeah,
Yeah. And, that being said, it would be nice to have some of the data. It would just be nice if the market didn't have a spasm every time the data wasn't perfect.
yeah,
Kind of like corporate earnings. It's the same thing. A company, comes in a penny short or a penny over, or they guide slightly higher, and the market, for that stock goes berserk one way or another. And in the grand scheme of things, it has no impact on that company
All right. Two,
in many cases.
you just gave me two things to chime in on here with. Uh, hold on one second. Okay, so first off, you mentioned that you live near the DC area, and there have been, you know, job reductions, Doge, et cetera. Um, I don't really have an update on this, but I remember hearing as we went into the government shutdown, I'm trying to remember the fellow's name and what position he had, but uh, I'm not going to remember, but it seemed that the shutdown actually gave the administration more authority to cut jobs rather than just furlough people, at least in the executive branch. And I think there were actually some layoffs that were announced, but at the time, this was 2 weeks ago or so, at the time, you know, the administration was sort of beating its chest, was like, okay, hey, kind of a misstep here on the Democrats. If you don't want us to get rid of people, you just gave us an opportunity to really start trimming some of this fat here that we've been trying to get done. Is that happening? Are you hearing anything from your either DC contacts or your people who just live in your area about this?
I mean, I personally don't see anything.
Okay.
I know they did fire. It wasn't a big number. A few thousand,
Yeah, I
five
want to say I heard like
thousand.
4,000, something like that. Yeah.
But that's not, I mean, the DC metro area is, I don't know what it is, 3 million, 3.5 million. It's nothing, you know, and how many of those people can get a job relatively easy? Uh, it's sure a few people have lost their jobs and it kind of sucks. I think the bigger impact to the DC area is that they're not getting paid, these government workers. And that is, if this continues, they're starting to miss paychecks. That will have an impact on their debt, on how often they go out to dinner, spending money. So that'll be interesting, but we're probably still a couple weeks out for that to have a big impact as well.
Okay. And by the way, the guy I was trying to remember his name is he's the budget chief, Russell Vaught.
Yes, yes.
Um, yeah, and they're calling these reductions in forces, you know, not furloughs, but we're actually getting
Mhm.
rid of these folks. So this article here from October 11th quotes the 4,000. You know, it's been 2 weeks since then, so you know, I'm curious to hear if anything more of that has happened. If anybody knows, please let us know in the comments below. Okay, so the other thing you mentioned was, you know, kind of the noise and things that wing the markets around. Um, you know, both you and Lance have been commenting on how there's a lot of speculation in the market today. And we've seen some meme stock activity now happen in brands like Beyond Meat and Krispy Kreme donuts. So I'm just curious, I mean, what are you taking from that, that we just still have too much froth going on in this market here?
Yeah, I would also like to know where the SEC is when you need them. I mean, these are just scams,
They're shut
literal.
down, man. It's government shutdown.
Yeah, they weren't there before either. But yeah, it's just people, investors it's the line between gambling and investing has kind of joined. So when you think about sports betting, it's kind of all or none. You either can make double your money or you lose your money. If you parlay, you can multiply it three, four, five, six times or lose it. And investing is kind of working its way towards that all or none, that binary outcome, where it seems like more and more investors are willing to buy Beyond Meat. The stock was a 50-cent company. It dropped from 75 cents to 50 cents like a week ago because they're restructuring their debt because they're on the verge of bankruptcy. They heavily diluted the equity shareholders, that's why it dropped, even though 25 cents isn't a lot, percentage wise, it's massive for a company that I think was a 200 something dollar stock 3, 4 years ago. Companies basically on the verge of bankruptcy. Their sales are declining. Their product is not, as wanted or needed as was originally thought. They've never turned a profit as a public company. And then all of a sudden the stock's trading at 8 because of some guy on social media that I've never heard of saying he's buying. He bought. He bought at 50 cents, at 60 cents. Then he goes, he tells you what he's doing. Everyone jumps on board. And guess who's selling to those people at 6, 7, $8 a share? The guy that bought at 50, 60
Right. The
cents.
dude who
He's
actually
out.
started the whole thing. Yeah.
Right. He's out. He's been out. And then it works its way right back down. There's I there's a stock 1-800 Flowers. You've heard of them. I think it's
Sure.
FLWS. On that day where Beyond Meat took off, it took off. It went from 5 to 8 and back to 5 in a day. Why? Nothing happened with their earnings. There's just a heavy short base. These meme actors kind of go after stocks with heavy short bases because they want to get the shorts to have to cover, cause the pop, cause people to jump in, make their profits and get out. And it's 20 years ago, this was unthinkable. If we think about why Martha Stewart went to jail now, it's beyond ridiculous compared to what these people were doing.
Yeah,
So,
it's not unlike shorting a bank and then convincing all the depositors at the bank to run in and ask for their money. And then you create a run
mhm,
on the bank and the bank, gets in trouble and your shorts make a lot of money and then you're out, right? But you've
right.
destroyed a bank in the process.
Right.
Yeah, it's just
Right.
unhealthy.
But I think, right, to your initial point, I think what it really does is it talks to the speculation in the market. In our commentary, either today or coming out Monday, we posted a graph of small cap companies with negative earnings have beating small cap companies with positive earnings by like 30% since April. So, people are so a lot of negative companies are based on hope that their earnings are going to grow, hope that they're going to either fix their problems to get earnings to grow, or in a lot of like technology cases, they have a great product, they're investing the money now, they'll grow later, earnings, right? First is a company with earnings that's already producing, that that you can predict. And you're seeing that across the board, that the hope is trading much better than the predictable. The bird in the hand is not worth as much as two in the bush, as they say.
Hmm.
Uh, Whereas I think a lot of philosophers would argue they'd rather have the bird in the hand, or fundamental stock traders.
Right.
It's much easier to predict. It's just we see it in just crypto. If you're a company that's involved that makes, we talked about this I think 2 weeks ago, the kimono company that's going to be buying Bitcoin that's now up 300%. So what? They're going to be buying Bitcoin. Well, why should that affect their valuation?
Right.
Because it does. Because if you're involved in crypto or AI or data centers, that's good. That must be good. You're going to make a fortune.
Yeah,
So,
it's interesting. So, when you're in times of froth, I mean, these are sort of late stage, right? Everybody wants the sizzle, right? When times are tough, everybody wants the steak, right? And right now it seems that sizzle's trading at a high premium and steak is probably undervalued.
mhm. Exactly. And you could see it in all parts of the market, even, even safe parts of the market, the riskier part of the safer part, like in utilities. Some of the, like utilities more on the nuclear side are going through the roof.
Right. But
Those
that's sizzle,
companies,
right? They don't have any incremental revenues yet. It's all story.
right. So this is the interesting. So here's a great example. We like the natural gas MLPs. They are providing gas to the data centers today. They will be providing it for the next 5 years because there is no alternative. The long run alternative may be nuclear. Those plants can take 10 years to build, and who knows what companies doing it today will even be around 10 years from now. The market would rather have that hope that nuclear is the answer 10 years from now and the profits from that 10 years from now than the answer than what is feeding these data centers.
Right.
And these stocks like nuclear related stocks going through the roof and the MLPs are going nowhere.
Yeah, and that's why I keep asking you about oil. Is oil is about as and natural gas. I mean, fossil fuels are about as stake as it gets, right? I mean, these are the things
Mhm.
that power the world, and these are companies with real profits and real dividends. But in a lot of ways, they're just being completely overlooked right now.
It's not even steak, it's hamburger.
Yeah, right. Or it's the cow itself, right? It's just as
Right,
base as
right.
you can get. And look, I own some of these nuclear stocks, and I hope they continue to do great. But if and when we get to a point where the froth gets bled out of the market because of whatever reason, right? The economy slows enough, or we start taking losses, or people realize that AI was truly in a bubble and some of that immaterial amount of that market valuation starts going away. Um, when people start getting, when the party starts ending, where you can't get away with getting by on sizzle alone, the market's attention is going to turn back to the stake. And
Right.
right now there's some of these areas like fossil fuels that just seem like they're really good values. Now the question is when are they going to turn, right? Just because they're cheap doesn't mean they can't get cheaper, right?
Yeah, yeah. But it's creating opportunity. The question is who has the patience to wait it out, to both wait for those, sit on companies that are not keeping up with the market or even declining and waiting for their day in the sun. And whether that happens when all other stocks go down and because the froth has left the market, or just all of a sudden, like if Amazon or Google signs a deal with a pipeline and then, oh, wait, pipelines are also part of the AI trade,
Hmm.
all aboard, and they join the sizzle, right? Regardless of what the market does. So as an investor, you have to be diversified and you can't just put all your eggs into the natural gas part. You can't put them all into the nuclear part. And you have to spread those bets around a little bit. But you have to be willing to have patience for some of those bets and understand your risk tolerances for other parts of the bet. Take profits even though they are going up.
Yeah.
So, portfolio management helps you kind of steer through periods where you have this big divergence of what's in and out of vogue.
Yeah. And on that part yet, are you guys increasing your exposure to the energy space yet, or are you maintaining what you have and looking for certain technical signs to then start adding in the future?
So we did add last week 1% more to our natural gas pipeline position. We are contemplating adding a little bit to more traditional energy company, but we haven't done anything yet. But energy has been on a relative basis one of the cheaper sectors in due for a rotation, but that rotation may not come until the market weakens too.
Right.
When investors start flocking to staples and energy and some
Well,
of
and it,
those.
and it doesn't mean it can't get even cheaper, right? I mean, as you mentioned, OPEC's increasing production. Hey, maybe there actually eventually is
That's
a
right.
ceasefire in Ukraine and Russia oil comes back on the world market again. And, that would, you'd expect that to lower prices, right? Because it's no
Right.
longer under embargo. So it doesn't mean that, things can't get cheaper before that sector really fully turns. Um, but, I will tell folks that I am, the little position in energy I'm adding to it right now on the fossil fuel side of things. Don't do it because I'm doing it, but I am just letting folks know that I'm starting to do that, um, and we'll see. But Michael, do you if and when oil the sector does start turning up, do you anticipate increasing the percentage of your portfolio that's exposed to that sector, or do you feel like you're pretty much at the weight you're going to be and you're just going to ride it?
So part of the problem with that is if you just look at XLE as a guide, the Spider
ETF.
Energy ETF sector ETF, it has done much better than the price of oil. So there's a decent gap there where you would expect XLE to have fallen more than it has, or underperformed the market more than it has. So that's one thing that's keeping us a little wary. Will it catch down to the oil market? Might the oil market zoom up, but the energy stocks have kind of priced it in, so to speak, or might they both go up together? So that's one of the considerations we've been talking about.
Okay. And I think one of the nice attributes of this sector, um, I'm looking at it with the scars of being a longtime precious metals mining stockholder, where there were many, many years where those stocks just really did terribly. Um, and then finally, the thesis has proven out much longer than I thought it would, but it's been a great year so far for these companies, right? Um, but with oil, a lot of those companies pay nice dividends, right? I mean, there's a few of these mining stocks will pay dividends, but these oil companies are really good, and have been very consistent dividend payers. So to the extent you have to wait, you get paid to wait.
They also tend to be less risky. They're in safer
Exactly.
countries. They're much more adept at hedging. I feel like they've gotten better about not just drilling because the price of oil is high. They understand that the price of oil goes up and because the price of oil oscillates. Gold tends to trend higher. It oscillates within the trend, whereas energy tends to stay flat. So they've gotten much better about not just going gangbusters at the top of the range, but better economics behind their drilling processes. So they're better, they're much better managed companies. They do pay good dividends. They have decent valuations. Um, but nonetheless, their prices are largely their revenues and their earnings are largely tied to the price of crude oil and to a lesser degree, natural gas and some of the uh, other energy forms that come off of oil.
Hmm. All right. Well, we'll keep checking in future market recaps here going forward, just to track what's going on here. All right. So, couple things I want to get to, but first let's go through the bond market. So in the day we're talking here, the US 10-year is trading with a three handle. Now it's just a little bit below 4%. We've had a couple of days this week that have been below 4. You have been very consistent, Michael, in saying that you thought that bond yields were going to drift down from where they've been. So this gives validation, to what you've been saying. I assume you still forecast that they're going to go even lower throughout 2026 than where they are right now?
Yeah, I mean, it's been a slow drift. Um, the bond market technically looks decent. It's forming on a price basis, higher highs, higher lows. We kind of had a double bottom. So, it's not a sizzle trade. It's just a slow grind, lower in yield, higher in price. You can see a lot of the volatility has been taken out of the bond market. You have a bad auction or a good auction, and bonds move a little, barely. CPI today, the move was almost imperceptible. So you've really reduced the volatility, and I think you've stripped out some of the narratives that were going around about inflation, tariff inflation, about the deficits. Those you don't hear people talking about those anymore, right? Which is interesting because the debasement narrative is going full steam, but bonds are doing fine. So, what was plaguing bonds was that term premium that we have talked about before, and that term premium has come down as those worries ease. It doesn't mean they can't come back. And then
Hmm.
you couple that with generally the economic growth rate has been slowing. Inflation has kind of been stuck, but I think we can blame it on tariffs for the most part, and that over time it's expected they'll come back down. If you look at inflation expectations, they've been drifting lower alongside with yields. So the outlook is good. If we get into a recession, you could see them drop quicker.
Right.
If we just have this slow grind economy, they'll probably slowly grind a little bit lower. Um, got the Fed meeting next week. They're going to cut rates. They're probably going to talk about either remove QT or talk about a plan to get rid of QT by year
Mhm.
end. So that on the margin is somewhat positive. More of the QT part. The you have to be a little careful with the Fed. If the market starts thinking the Fed's easing too fast or too much, they may think it's inflationary, which could hurt the longer maturities. But the pace seems pretty measured right now. They'll most likely cut rates next week, but maybe they'll take a month off or they'll reassess the situation. So, I think the Fed is somewhat constructive for bond yields as well along with the economy.
Mhm. Okay. Um, well, I'll tell you, in terms of yields continuing to drift downwards, you're in good company. The I just did this conference, right? So the Lacey Hunts, the Stephanie Pomboys, the Grant Williams, the Danielle DiMartino Booths. I just interviewed Ed Dowd. They all agree with you on this. Not everybody is on this train, just being really
Right.
clear, but you've got some big names there. Let me ask you this. Uh, at the conference were folks like David Hay and Jim Grant, who have spent much of their careers really following interest rates and had the 40-year bull market in bonds. Um, Both of them feel like, okay, that's over. That bull market's over. And going forward, we're probably going to have secularly higher rates. Now, it doesn't mean that rates can't go down for a year or two, right? But they think that they will be drifting higher, not lower, say, over the coming decade. Um, where are your guys' minds at RIA? I mean, clear, you think they're going to come down into 2026. Do you have a point of view of the longer term secular direction of interest rates over the next decade?
Yeah. So, if the government continues to pull the games it played in 20 during the pandemic and afterwards, rates could easily drift higher. If inflation gets stuck at 3%, they may reset higher. We'll see. Look, our job as investors is to worry about the next few months, the next year.
Yep.
Where things are going to be in 10 years, I don't know. They don't know. A lot will change between now and then. I like Jim Grant a lot, but he has been on the bearish side of bonds. He'll eventually be right, but he's been on the bearish side forever. My coffee mug is, I don't know if you can see it, it's a Grant's mug. I think he does some great work. Doesn't mean I agree with him on certain things, but I'm focused on the next 3, 6 months, year. Uh, Look, stock market is telling us that returns are going to be 0% for the next 10 years, plus or minus a few percent. Why do we hold stocks then? Because no one is telling us how we get to 0%. We
Right.
could go up for 5 years in a row and have a Great Depression in 2029 and then rally for 4 more years after that. Or the bottom could fall out tomorrow and we could have 9 years of a glorious bull market. We don't know how we're going to get there, just like we don't know what's going to happen to bonds over the next 5 or 10 years. A lot will change. And it could change for the better, could change for the worse.
Okay. All right.
But
Well,
but you know, but Jim Grant has been on that horse for 20 years. So the fear is he will be right at some point. It's just when.
okay. All right. And you and your cohort there, we've talked about the analogy of the car with the headlamps. Your job is reacting to what you can confidently see in the lights that your headlamps show. You worry less about what's out in the future darkness, and because you deal with that when it comes into the light of your headlamps.
We think about it though. When we talk about this stuff, we research it, we think about it. I don't just say, oh, who cares what happens in 2 years? We write about this stuff all the time. So, it's not, we're drivers. And certainly what matters most is what's in front of us. But we also want to know where that road is going to bend and where there's, potential for bad weather or whatever's coming down the pike. We want to be ready for it and mentally prepared. so that if something changes drastically, we're not shocked. We know
Mhm.
what to do. We have a plan B, a plan C. And that's, and to some degrees as important as just what's out my front window. What can I see right here?
Mhm. All right. And thank you, Michael. I mean, again, one of the big reasons why we do these weekly recaps is that people can see how a good, experienced professional money manager thinks, right? Because
Mhm.
it's a real-time developing process, right? You've got some major theses, you've got some things you've got high confidence on, but then you're just having to react in real time to lots of different changes.
Right. I mean, if I tell you with certainty NVIDIA is going to be a $5 stock 5 years from now, a lot of people would say, oh, I'm going to go short it. Well, on its way to five, for what is it now, like 180 or something, you short it today, it goes to 500. You get margin called, you lose a ton of money, you get pulled out of stock, and it then proceeds to go from 500 to 5. The point is, no one knows the path on how markets will travel, even if you have a good idea of what the expected return is.
hmm
So
Yeah,
just
and
be
this again
careful.
is it's another reason why, there are a lot of DIY investors that watch these videos, and I say, look, if you can take inspiration from what Michael and Lance and all the other experts that I interview, if you can take inspiration and insight from all their outlooks that make you make better decisions, fantastic. But there's a lot of regular people, Michael, who they've got other things to worry about. They don't have the expertise that you do. And so, they ideally would like to have a set it and forget it. Oh, okay, NVIDIA is going to 5. Well, let me make that decision now, and then it'll pay off at some
Right.
point in the future. It's a very dangerous game to play like that for the reasons you just mentioned. You can get killed multiple times all along the way. And this is why I think for those people, finding a good financial quarterback is the right decision for them. Not what's the next best asset to put in my portfolio, but who actually is the best professional to manage all this for me so that I can focus on the things I'm good at and let them take over the active management of this important stuff. All
And
right. Oh, go
do
ahead.
me a favor, Adam.
Yeah.
Please don't make the title of this, Mike thinks NVIDIA is going to 5.
Oh, really? Because I thought that was, I mean, we were going to get a ton of eyeballs with that one.
You will.
Yeah,
It's
and I
not going
think
to
you
look
said
good on
it
me, but
guaranteed
it
with
will.
confidence. I was thinking Mike Lebowitz guarantees with confidence that NVIDIA is going to hit 5. All right, so let's now move to the quote unquote debasement trade, which was all in the headlines, a week ago, as gold and silver were continuing to zoom to new all-time highs. Now we've seen them sell off a bit, um, and you've just written a piece about the debasement trade and really asking, hey, is it a real thing, or is this maybe more narrative than reality?
Right. And the reason it's important to me is because this narrative, and a narrative can be true or false, is really what's driving the price of gold. If you look, how many times does the word debasement show up in the media? That number has skyrocketed over the last few weeks. Everyone all of a sudden knows what debasement is. No one had ever heard of the word 3, 4 weeks ago. Now everyone knows what debasement is.
Yeah, well, sorry, just
Uh,
to interject, but the irony there is that, of course, the people that have been invested in gold and silver, many of whom watch this channel, have known about it forever, decades in many cases. But I guess it took $4,000 gold to wake up the financial media to this.
Debasement is the wrong word for what's going on. We quabble about definition, but I felt like I needed to put out an article about what's going on. And as I was kind of thinking about this, I was like, well, what's rebasement? If we wanted to rebase the economy, what the currency,
Currency.
what would that look like? Because if you can agree on what rebasement works, debasement is just the polar opposite. So when I think about rebasement, I'd go back to the gold standard. If you want to rebase the currency, you're going to, the base, the foundation, you're going to do something with the structure of that currency. So let's go back to the gold standard. But the point is, we haven't had a gold standard since 71. So how are you debasing something, this foundation is not being debased. Now the popular narrative for debasement or the popular definition is excessive money printing, money supply, uh, declining purchasing power, and a loss of confidence. So I went through my last article, which showed up on Wednesday. I'm going to share my screen here. I want to walk through those three definitions to see if something has materially changed over the last 6 months or even longer. And is this debasement story real, according to those three definitions, or is it more of a narrative used to support the price of something going up? So first of all, money printing. The Fed doesn't print money. The government doesn't print money. Banks print money and they do it through loans. When a bank makes a loan to a person, money is created. That's it. It's final, right? Now the Fed can incentivize money creation. They can lower rates, they can lower reserve requirements, capital requirements. They can do a lot of things to try to incentivize the banks. The government can print money, but they can borrow money. Again, a loan, it's a loan, even though it's a security, same concept. But with that, and look, believe it or not believe it, it doesn't really matter. Is the Fed in a mode where they're incentivizing money creation? And what I'm showing you here is that Fed funds minus, CPI and GDP is very elevated. We've talked about this. Fed funds are over 4%. CPI is 3%. GDP is closer to 2%. Historically, that's a very restrictive level. So basically, they're not incentivizing money creation. Then you throw on top of that they're pulling 40 billion of liquidity out of the market every year or every month because of QT. That's further restrictive. So there's nothing there that the Fed is fueling money creation. This, Adam, this graph is the most important. Well, the money, so they're money's being printed. We can debate all day who's printing it. Money's being printed. Well, money should always grow with the size of the economy, or you have some big problems. If it can't keep up with that, you're going to have deflation, and you can't run an economy in deflation. So what I have here is the growth rate of GDP, or the GDP and the money supply in green and blue, and that darker blue shading in the back is M2 as a percentage of GDP. It popped during a pandemic. That was concerning. And then it came back down. Right now, it's at the same percentage, more or less, that it was in 2017. That was 8 years ago. I'm not saying that the trend higher is not bad, but there's nothing in this graph that tells me that debasement is occurring because of M2. M2 as a percentage of the economy, obviously, ignore that blip. But where we are today is about the same as a percentage of the economy. What everyone seems to forget is the economy has grown almost 50% in the last 5 years. We're a much bigger country economically than we were. So excessive money supply, that's not going on. We can say it went on in 2020, 21, very short-lived, and in many ways it was erased. It's happened it happened during World War II. There was excessive money printing. We won the war and it reverted back closer to normal. So the second one is purchasing power. And, the argument goes, well, I used to be able to go to the movies my dad would go to the movies for 50 cents and get a thing of popcorn for a nickel and blah, 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 right? But that fails to consider how much money he was making, how much money how his wealth was accumulating. So here's a long-term graph of real disposable income. It's rising. That means our incomes are growing faster than inflation. Real is just after the rate of inflation. So the trend is upward. It doesn't mean there aren't periods where it goes down slightly, but it's upwards, meaning that we're making more. So yes, the movies cost 15 bucks, 20, I don't know, I haven't been in movies in a while, 15, 20 bucks, but we're not making $3,000 a year either. Our standard of living is higher today than it was in the 50s. And that's for both the rich and the poor. The standard of living has risen across the board. It doesn't mean that there's still a growing inequality. I'll be the first to tell you that. But the standard of living has increased for everyone. Wealth, the ability to generate wealth. So you have money, so the argument's like, well, I know, but a dollar doesn't buy what it used to. Well, if you have your dollar in a tin can or in your mattress, you're right. You lost, right? That dollar buys you a lot less than it used to. And that's the graph we see all the time. But here, if you just invested your money in 3-month treasury bills and rolled them over every 3 months for, would I go back to 1950? You were better off than if you were just invested in inflation. So if your money just went up with inflation, you were better off in treasury bills. Treasury bills are about as safe as it gets. That's the least riskiest investment there is. A lot of people are invested in stocks or longer term bonds or a whole host of things in real estate that went up much more than T-bills. So our wealth has grown more than inflation, our incomes have grown more than inflation. So it's the people with money in tin cans that can really argue that their purchasing power has been wiped out. Um, loss of, I'm sorry, did you want to say something?
Yeah, I did, but I'll wait. Keep going.
Okay, I'm on a roll here, Adam. Let me go. Uh, so loss of confidence in the currency. Here's your dollar index. Is there something in that index that tells you that there is a complete loss of confidence? It's down 10-15% this year. Look at how many times over the last 50 years it's been up or down 10, 15, 20%. It's had much larger moves. The orange line shows you it's basically at the average of the last 50 years. It's oscillating like it always does. Countries have to buy and sell dollars to trade. And when the economy slows or picks up or when exchange rates change, that all plays into the dollar. The loss of confidence, if foreign investors are much more affected by the value of the dollar than us domestically. And if I'm a foreign investor and I have no confidence in the dollar, if I'm a foreign investor and I want to buy Nvidia, my first move is to take my currency, let's just say the yen, and then I convert my yen to dollars. So I've already made one bet, the yen to dollar ratio.
Mhm.
Now I take my dollars and I buy Nvidia, right? And if Nvidia is up 10% over the next year, that's great. But if the dollar loses 10% to the yen, I'm break even. So for a foreign investor, currency is important. What's that currency going to do? They want to buy US investments when they think the dollar is going to rise against their home currency and sell when it's not. So the graph on the left is just foreign debt held by foreign and international investors. Is there something in that graph that tells you that there's a confidence problem in the dollar? And look, if you kind of look at it, the trend has actually picked up in the last few years,
Mhm.
the growth rate. Equity investors too, they're largely buying our equities, not selling our equities. Um, so you kind of walk through those three arguments, they don't make sense, or they don't pan out according to what the statistics are telling you. There's another argument that says, well, that's fine. Gold is priced in ounces per dollar. And it's not gold that's going up, it's the dollar that's going down. The real dollar, not indexed against other currencies, the value of the dollar, right? And people are buying gold because they want hard assets. Well, then why isn't oil going up? That's one of the hard, it's liquid, but it's a hard asset. Why is real estate, we talked about this earlier, why is real estate stagnant, right? The graph on the left shows you the gold to oil ratio. That should be a flat line. Oil should be rising with gold. If people want out of dollars, they want nothing to do with dollars. There's your case Schiller. We were talking about that early. That's heading towards 0% right now. There's nothing in that trend that tells you people are clamoring to turn their dollars in and put it into real estate. Same with many other commodities. And why are bond yields dropping? If no one has any faith in the government and the currency, why are they willing to lend the government money? Why are they not taking those dollars and buying assets? So, in my opinion, the whole debasement story makes sense. Doesn't make sense. I get that there's some questions about the faith in the US government and deficits and all that stuff. But when you really look through the data, has it really been that different over the last couple of years? Really, I mean, gold has, what has it done? Doubled in the last uh, year and a half?
Yeah.
There's, I think gold is getting ahead of itself, and the narrative is used to support that. I'm not saying the fiscal situation in this country is great. I'm just saying that its rate of deterioration is not really that different from the trends that we've been on. And to all of a sudden assume that we're just all of a sudden going off the edge of a cliff, I think you're going to end up getting caught. And I think this graph kind of tells you a lot. Call volume of GLD, the gold ETF. It's speculative. It's not that gold isn't an okay long-term holding, but I think it's gotten way ahead of itself on where it is. And I actually had this graph I was going to do after that market, but we kind of skipped it. The one on the left is the last few years, and you can just see the moving averages. It's been in a great bullish trend for the last 2 years, from 1600 up to 4400 recently, right? But if it just falls back to the 200-day moving average, there's nothing bearish about that. That's what bullish trends do. They
Right.
do bounce off these key moving averages. You're talking 3300.
Yeah. And it would still be in the bull trend there.
Yeah, it's still bullish, right? And the longer term graph goes back to the late 70s. That's on a logarithmic graph, so all the percentage changes are equal. And I drew that green line, and you can move it around a little, but it's a good approximation of the trend line. We're on that bullish trend, and you can drop on that graph to 2500 and be right on trend. You can drop below it like it's done plenty of times in the past too. So the point is, really understand what the narrative is truly saying and is it true. Doesn't mean we do have problems in this country, but is gold is telling you that this country is that the currency is going away, that we have completely debased it, the rate at which gold is rising. And that's where I find fault with this whole thing. And I think you can just see it in the speculation. And yeah, I wanted to draw this cartoon of, I think there's a lot of gold holders that are looking all around. They see all these bubbles, but they don't see the bubble that they're in. And, I think it could be unfortunate because I think gold will correct. It's gone too far, too fast, and it's not reflecting fundamentals at this point. And Adam, just for the record, I own gold. I've owned it for almost over 2 decades now, and I will continue to hold it. But you have to separate price from reality, just like you do with stocks, just like you do with bonds. Gold is not any different. It's an asset that's where does all the volume in gold? It comes from the futures exchange. That's really the price setter in gold, and that's what's driving gold prices. I know a lot of your viewers are not going to want to hear that message, but that's my take. And Lance is largely on board with that.
Yeah, and I very much appreciate that. And I've been having these discussions with you and Lance over the past bunch of weeks. And like you, I have been adding my voice to the chorus of saying, look, any asset that goes this far, this fast, generally is getting caught up in some speculation. And I have been encouraging people to consider hedging in the event of a material pullback. So I'm right there with you, and I appreciate this. And really, the MACD on the chart there on the left, really
I meant to show that.
yeah, really shows you how overstretched the gold price has likely gotten in the short term here.
Right.
Folks,
The
that's just
time for the time for the debasement article was 2020, 21, 22. Gold
yeah, when
was
we were
not doing
cranking out
much.
these trillions
That's when we were really hurting the credit and faith in our currency.
Yeah. So, I mean, what some people would say, Michael, and you don't have to agree, is some people would say, well, look, this is a repricing, right? Gold didn't move in response to that the way that it should have. And now this is the world kind of waking up to the fact of the debasement that has happened. And I will say on some of these things, dollar versus other currencies, US Treasury yields, whatever, you can make the argument, you can do the pushback of, yeah, but we're the cleanest shirt in the dirty hamper, right? That like every other country is doing the same thing and oftentimes even worse. So on a relative basis, you would expect the US to continue to outperform, right? The other question I have for you here, and I'm not trying to undermine your argument in any way. I think it's totally sound. I think every gold holder who especially is sitting on big gains right now should be taking this with you should be listening very closely to all this. But if you can go back to the chart of, what was it, real personal income,
That one.
real disposable personal income. So in many ways, you're absolutely right. The average person enjoys a much higher quality of life than we did in the 60s. And you can measure that in terms of prevalence of antibiotics and the healthcare that we get. You can measure that in, we have these magical devices that give us all the world's knowledge for very little cost. We have dependable hot water and electricity grids that are much more dependable than they were back then. We've got a much more national infrastructure. I mean, there's all sorts of things that, again, we can all go take an on-demand hot shower, which is something that like the pharaohs couldn't do, right? So there are
Well, the
elements like,
pharaohs could, everyone else couldn't.
well, they didn't. I don't think they even had a on-demand hot shower. They had to get some slaves to go boil
Well,
a
that's
bunch of
right.
water, and they could take it in 5 hours, right? Yeah.
Yeah,
Um,
better
so
than nothing.
better than nothing, yeah. But my point is I'm conceding your point that there are a lot of ways where our quality of life is better on those dimensions. Now, you know, I was young, but I lived through the 70s. Back then, you could have a one income household that could, support the whole family, and you could still take at least a vacation a year. It wasn't necessarily a fancy European vacation, but you could throw everybody in the back of the station wagon and take them somewhere fun and all that stuff, right? And your kids got educated and all that type of stuff. And so I look at this particular chart and think this tells a story that doesn't feel true to a lot of people. And I'm just curious if one of the things that could be distorting this, because you're using CPI as the discount factor here, right?
Mhm.
And I know you think CPI, probably doesn't match your reality when you go to the grocery store. You mentioned that earlier, right? Where it has been, the calculations of CPI have been changed over the decades, right? Adding hedonics and all sorts of other substitutions. And, well, if a TV adds X, Y, Z bells and whistles, then we're actually including it as even cheaper in the calculation here. So I know John Williams at Shadow Stats tries to calculate the inflation rate kind of using 70 styles equations, and I'm not sure if that's the best one to use or not. But it'd be interesting to see this chart with kind of a completely hedonicized version of inflation to see if it's not flatter.
Oh, I'm sure it's flatter, and it depends on who you are, where you live, what you spend money on where it is, how that's changed. It's definitely flatter. The point is it's rising. It's increasing. And look, John Williams he's been telling you inflation's been 8, 10% for the last pre-pandemic, right?
Yeah.
Well, if we're getting 3% pay raises and inflation is 8%, we're losing 5% of purchasing power a year. How is it that for the large majority of people over time they get ahead in life? They don't work their way into squalor despite having jobs. So, I don't know what the inflation rate is. And Adam, we can have debates all day about the quality of life and the wealth inequality, the gaps. There's a lot of social issues and problems. I'm not saying it's perfect, but I am saying that from the poor to the wealthy, they are financially better off today than 1950. We can argue all day about family life, family structure, a lot of different things. But from a purely financial view, and look, I get it that both spouses are working in some cases. That changes the equation. But the facts bear out that after inflation, people are making more money today than they were.
Okay. And really where I'm going with this is even if somebody doesn't fully swallow all of the data that you've had here for some of the reasons I've just mentioned, what I take from the data here, Michael, the most important thing I take from the data here is we don't seem to see anything in the past couple of years that suggests that the purchasing power of the currency is going to zero, that the world is giving up on the US. All these things that these debasement trade headlines are kind of causing people to feel panic about.
Hmm.
So,
Right.
the data does not suggest panic. So if you are buying gold in a panic because you feel like, oh, this debasement trade is basically taking my dollars to zero next year, that would probably be a very unwise conclusion.
Right. Right. I
Yeah.
mean, you look at all these graphs, and there's nothing in any of these trends that look like the change in the gold trend, in the gold price, which has gone almost it's almost like turned a 90-degree corner. None of these are pointing in that direction, um, which leads me to believe that it's not, the narrative's nice, it's handy, but it's not necessarily true. This is speculative juices flowing through the market.
Okay. And again, when things get speculative, they get very frothy. At some point, the
And
froth goes away, and that's when you can get in real trouble, especially if you're buying in at the late stage of the speculation.
and by the way, futures, which largely drive the price of gold, are a margin. You're trading that stuff. Futures trade on margin by definition. So I don't know what the margin requirements are, but it's probably at least 10 to 1. So it's the speculation is multiplied within a futures market. We know that there's all these levered ETFs that hold gold or silver that are also doing that. Gold miners, in a way, are levered positions on gold,
They are definitely.
uh,
Yeah.
for better or worse. It works both ways, obviously.
Yep.
So, just I hope this just shows another side to the argument. Obviously, your viewers can take whatever side they want or find some middle point and agree or disagree, but this is how we see it.
No, I very much appreciate that. And again, you know, any asset you buy, gold, stocks, Nvidia, whatever, right? You should be basing on data, not just on narrative, right?
Right, right.
Yeah. Okay. All right. Well, look, in starting to wrap up here, trades. You mentioned briefly that you guys added 1% to your natural gas pipeline position. Any other trades in the past week?
We did all these trades Monday or Tuesday. We added a 2-3% to both our equity and sector models. We brought some positions up to where we wanted to. We added to Meta. We've been wanting to do that for a while. It had sold off. It came on a nice buy signal. So we added to it. We added to Kinder Morgan, which that's our pipeline. JP Morgan got beat up on earnings. We took advantage of that. And I believe we added a little bit to Amazon as well.
All right. So kind of a
So
busy week.
yeah, I mean, look, at the end of the day, it was a couple, 2-3%. It's not really moving the needle. It's kind of a bullish rebalancing.
Yeah.
It's not
Because I didn't hear any trimming in there. I mean, you were mostly buying this time?
I'm sorry, we sold ServiceNow. We like the company. It just hasn't been working. It's kind of resting on a lot of our risk limits. So we said, let's get back to it another day.
Hmm.
So net, this isn't let's put the pedal to the metal and just, buy whatever we can here because the market's going to zoom into year end. It's we're already pretty much fully exposed. Let's just, add a little bit in companies or sectors that we think have gotten beat up a little bit more in the market and are giving us some good technical indications.
Okay. All right. Good. Well, again, thanks for being so transparent. Hey, just getting back to the gold thing for a second, I do want to express my appreciation. Um, I know you prepared those slides, probably feeling like you're going to deliver a message that maybe a lot of people watching this aren't going to be super happy about hearing about. And in my mind, Michael, that is exactly the kind of quality you want to have in a financial advisor, is somebody who's going to tell it to you straight, no matter if they think it's what you
Right.
want to hear, or what you don't want to hear. You want somebody who's going to tell you what they believe to be the truth and not just pander to what you think they want you to hear.
And Adam, look, I have been bullish bonds for a while. You know who I value most? Jim Bianco. He's one of the biggest bears out there, bond bears, right? I don't necessarily agree with what he says, but I try to read as much as I can because A, I know he's smart. He knows what he's talking about, and I want to hear the contrarian view. I
Right.
don't
And
want
he makes it with data too. He's not just slinging an opinion.
right. Like I love it that Lacey Hunt and I think alike. That makes me feel good about myself, but that doesn't do anything for me. He's kind of preaching from the same pulpit as me, but just using bigger words,
Yeah.
right?
Well, and a ton of data too, but yes.
Yeah, yeah. No, I mean he is like the professor. I'm the TA, or I'm not even a TA, right? Whereas Bianco, and again, I don't necessarily agree with a lot of what he says, but I want to hear that other view. I want to
Mhm.
hear where could I be wrong? What should I be aware of? Is he onto something? So, it's nice. It's a pat on the back when you read people that have the same opinion of you, and it's very easy to get caught up in your own views that you're right. Oh, I must be right because Lacey Hunt says I'm right. That's nice. But I get much more conviction from my ideas, my thoughts, my forecast when I focus on the other side. What are they saying? Why are they saying that? And then maybe my conviction weakens. You know what? Bianco's on to something. Maybe I shouldn't be as bullish or, so, like or not what I just said, at least think about it and consider it.
All right. And again, thank you for just caring and having the courage enough to just come out and present all
I
that.
don't,
So
I
thank you.
don't care. No one. Well, now they do know where I live because of you, Adam. Thanks.
Yeah. Folks, in the show notes below this, I'll put Michael's actual street address in case you want to show up at his doorstep and make a point. No, just kidding, my friend. All right. Because I know you're a sports guy, and because you kind of mentioned today, you mentioned briefly some sports, you cited some sports issues, and you cited some gambling issues. Just curious if you have any thoughts on the unfolding NBA mafia gambling scandal that's all of a sudden broken.
It's crazy. It doesn't surprise me. I mean, there's so much. This is part of sports gambling has always been a thing before it was legal, but I think legalizing it has really made it more mainstream, uh, and it's added to the profits. So I think being able to fix bets is just like what we talked about the meme stocks. It's fixing the result. And it's not surprising to me. It's a very easy sport to fix, because you can bet on players. How many points will they score? How many rebounds? Well, if a player gets hurt 5 minutes into the game, he's not going to meet those goals. And if you know he's going to get hurt and he tells you he's going to get hurt, that's an easy way for the player to make money and for the bettor to make money. So, I mean, I think it just talks to human beings that we will exploit whatever situation we have for our greater good.
Yeah, and I think, we've ranted a lot in the past about how we have really trained recent generations of people to be speculators, not investors,
Hmm.
right? Fundamentals haven't mattered for so long to a certain extent that everybody is said, "Oh yeah, you got to trade based on narrative," right? And younger generations have said, "Look, I'm regardless what your charts say, I feel like I'm not going to make the American dream unless I catch some rocket ride, some meme stock, some crazy crypto, whatever, right?" And so we've injected a lot more speculation into the markets, which of course you put a lot of liquidity in the system too, and that also engenders speculation. Um, there's a long-term corrosive effect of that speculation, right? It creates malinvestment. It sends capital to places it shouldn't be versus the places where it's creating true value. And I think it's true anywhere. And we're seeing it in sports too, right? You put enough speculation in there, yeah, the temptation becomes too great for the players or the coaches to
Hmm.
start taking falls, taking dives, and kind of making a mockery of what sport is, which is supposed to be the best person, the best team perseveres. not the team that stands to make the most off the spread on the bet.
Right, right. Beyond Meat's a good example. The market, not the stock market, the food market, the consumers are basically telling you the product just doesn't make sense
Yeah,
for
I just
whatever
looked at
reason.
that sales are down 20, sales of the plant-based meat industry are down 18% in the past 2 years. Like the
Right.
market
It,
is
it
speaking.
can't be from a profitable perspective, it's not sustainable, right? The capital markets where we buy and sell food and all that are telling you it just doesn't work. But now the stock has a new infusion of liquidity. That liquidity is being put into a stock that probably has no value. Could be going to cancer research. It could be going to a whole different bunch of other things that could be very good for society. It's not. It's chasing a company that will, you know, possibly end up bankrupt and the money will go to money heaven or hell or
Yeah.
wherever it goes.
Yeah. Um, well, I mean, again, this is why I think you can kind of make the intellectual argument that like, we sort of need a system cleansing to get rid of a lot of that stuff,
Mhm.
injure a lot of the speculators enough that it takes them a long time before they re-embrace that type of behavior. But of course, nobody, I mean, even those rooting for that is going to have fun during that corrective process, should one actually happen.
Right.
All right. Well, let's if we can get to a rant quickly, and then we'll wrap things up here, Michael. Um, Today's rant is about private equity ruining the world. And I've ranted with this in the past with Lance, but had a recent experience that I thought really drives this home. First off, I think I mentioned this last time that I'd heard it, but I couldn't remember the exact stat. But there are more private equity funds in the US than there are McDonald's now. So apparently there are 19,000 private equity funds and only 14,000 McDonald's.
I,
Kind of crazy.
I'm actually surprised there's only 14,000 McDonald's.
I guess. I mean, 50 states, 14,000. I guess that's a lot of McDonald's per state, but yeah. But the fact that there's so many more private equity funds really tells you, folks,
Right.
that this is a game that's being played. Now, what do private equity firms do? They buy companies with other people's money and a crap ton of debt. And then what they do is they take those companies, they jack up the prices, they dramatically cut costs, all in trying to service that extra debt. And whatever's left over, they pay themselves really generous management bonuses, right? So they're just basically just harvesting whatever cash flow they can take out of these companies. So what happens in the end? The company's hollowed out, the workers are all overworked and underpaid, and the consumer is paying more for worse quality, right? And I'm painting with a broad brush here. Not every private equity firm is a bad actor, and this doesn't happen in all cases, but it's certainly happening a lot, and we're seeing it in a ton of sectors here. Uh, Gretchen Morgensen, who I've interviewed on this channel about it, she's written at length about this, particularly citing uh, the injurious impact that private equities had in the healthcare industry, particularly in like nursing homes, where it's not just a P&L issue. I mean, this is really measured in like patient immiseration or early death, right? So the stakes are actually can be quite high. Um, what's interesting, is after these firms do all this stuff, right? They've enriched themselves by basically harvesting all the value out of these companies they buy, again, with other people's money. They then try to sell it to some bigger sucker, right? And I just saw a report that CalPERS, the big pension system here in California, or in where I used to live until recently in California, um, they just released a report called Why Private Equity is Important for Your Pension. Right. So they're actually trying to convince their pensioners, hey, this is all good for you, all the private equity that we're buying. And pension firms are kind of famous for being like the dumb money where Wall Street shows up and says, hey, this is how you're really going to meet your actuarial returns. Forget that boring bond stuff or even the stock stuff. Let's sell you this cool private equity stuff. Of course, this is the stuff that we know is going to just blow up in their faces, where it's going to underperform very likely. And at the moment where the pension's going to want those funds the most, they're going to be too liquid to extract, right? So we're seeing this. You could almost say sort of broad daylight robbery, right, of the corporate system by these pirates who who are coming in, hollowing at these companies, and then dumping the trash on the dumb money. Um, I'm kind of worked up about this right now because we took our dog. So I've got a dog. You guys have probably seen me put them on X, but our older dog, best dog I've ever had. She's a silver lab. Her name's Boston. She's absolutely uh, my daily companion, best buddy. So, anyways, she was looking like she had some sort of intestinal distress, and my we had a family member not that long ago had a dog who kind of woke him up in the middle of the night with intestinal distress, and it turned out their intestine had been twisted, and the dog had to be put down like that night. It was just out of the blue, terrible, one of those terrible things that happened. So I didn't know what was wrong with her. Maybe she just wasn't feeling well, right? Maybe this is something that was probably going to pass, like 98% of things that dogs have. So I called up the vet when the vet opened in the morning and said, "Hey, can you just check my dog out?" So we bring the dog in there, and the vet says, "Okay, yeah, but you didn't have a reservation today, so you're going to have to pay an emergency visit fee or whatever." Okay, fine, whatever. I care about the dog. And they kept the dog there for a couple hours, and they called me up and said, "Well, we'd like to take an X-ray." I said, "That's fine. And I'm assuming that that's going to be a bit, but okay, it's important to me to see if there's a blockage or anything. And we think your dog should have these anti-nausea things. No, and we think your dog should have this. And they called me a couple of times just asking if they could do, what seemed like a little X, Y, or Z thing. And at no point, and I should have asked, but at no point did they say, "Well, this is what this costs," right? So I go and pick up the dog after the dog being there for like 3 hours, $1,400 vet bill. And eventually, really all they did was take an X-ray and give the dog some palliative stuff. But there was no surgery. There was nothing in there that you would think, would be worth any of that. And at no point did they warn me, like, "Hey, we're getting over 500 bucks worth of care. Do you want to continue doing this? We're getting over $1,000 worth of care. Are you sure you want to do this?" Right? They just look at you with a smile and say, "Yep, that's 1,400 bucks." And look, for this dog, I would pay anything. But, we ended up really not doing anything with the dog except giving it time. And sure enough, she got better, thankfully. Um, but I'm just thinking of the average person, like the average person walking, especially the town that I live in, right? The average person walking in there and being slapped with a $1,400 bill. And all this stuff is just they're maximized to just generate whatever large expense they can as possible for the customer. Because I don't know if you've been to the vet recently, folks, but this has been a roll-up that private equity has done. The vast majority of veterinary practices now are not solo practices anymore. They might look like it, but most of them have been bought by private equity firms, and they're doing this across all veterinarians. So it's not like you can go to the cheap one in town anymore. They're all pretty much owned by one. So it's a big racket. I'm kind of angry about it. So anyways, that's my rant. What do you have to add, Michael?
I would just say it's going on because there's too much liquidity in the system. And that liquidity is creating these speculative juices, however that shows up, and it's just there's too much money, and it's not going into good things. It's going into trying to squeeze out pennies at the cost to society. So that's a much, much broader issue that's been facing this economy for the last, 40, 50 years. Uh, and we're going to see the Fed come in and help liquidity out. They're going to cut QT. Well, they're going to, indirectly allow for that pet shop or the veterinarian to keep, for that private equity firm to keep doing what they're doing. So until we have a change in the way that we focus our capital and manage our liquidity, I unfortunately, a lot of this stuff will continue or even worsen, whether it's private equity or just speculative gambling, not even investing, gambling, which is just squandering capital away
Uh,
instead of putting it to good use.
God, it's so frustrating, and particularly maybe so in the veterinary industry, just because they know they've kind of got you by your emotional short hairs here, right? Where they know that for most people, the animal is a part of their family, and it's like, well, do you want to put grandma down, or do you want to, pay up? And in most cases, people are going to pay up because nobody wants grandma or their best dog, to not make it for money alone, right? But it's
Right.
it's super frustrating, and it it's especially with that type of provider, that's where, especially in a small town, like those are the relationships that people really care about. And now it's turning what used to be a really respected and beloved profession into one that you just
Mhm.
start resenting now because you just feel like they're just trying to reach their arms as deep into your pockets every time you go there, right?
Right.
Sort of a similar issue here too. So when I moved to Reno, if folks can see, I got a haircut recently. Um, so I went to go look for I invest the least in my hair out of almost anybody, short of somebody who cuts their own hair. And so I was just looking for like, okay, where's a cheap haircut? And there really aren't that many like independent barbershops around here anymore. And it's because there are these hair cutting shops now that I don't know for certain if it's private equity owned, but they're franchises now. And you
Mhm.
go in there and it's not a bad experience, but it's basically haircut as a subscription now. So you walk in and they say, okay, we could give you a haircut, but really, we try to have a relationship with our customers and our pricing, this huge pricing thing on the wall. And they really heavily guide you into, well, buy our haircut subscription club. And there are all these different levels. And when you kind of do the math, at least when I do the math for me, I'm like, okay, like this haircut subscription things make sense because I'm on camera. I've got to get my haircut every so often. And your cheapest level to me is pretty reasonable price wise. And at least they promise that if you don't use it, it rolls over. So, it's not like if I'm late and going and getting my haircut, I've lost the money I'd paid. I can roll it over into the future. Um, and it's interesting because they've totally changed the experience. So you go in there, this is a guy's haircutting place where while you're waiting, you sit down in a leather chair by the big sports TV. There's a bar, and depending upon what level of service you pay, you get a free drink, and they've got a bottom shelf and a top shelf, so the premium guys get the top shelf stuff, right? You go sit in your chair, and every chair has a TV tuned to a sports game in front of it. So they've really kind of like engineered it for the bro, the guy, experience, which honestly is not, I'm like, hey, it's nice, right? I mean, I don't need it. It's totally wasted on me for the most part, but like I get it. I get why guys would want to come here and just, kind of get this type of experience. And of course, though, like anything like this, I mean, everything is an upsell, right? So it is kind of annoying. The first time you go there, they kind of give you the Rolls Royce treatment for the bottom price so that you know what's possible. And then of course
Right.
they're trying to sell you on all these other things. Um, it was fine for me. It's economical-ish at the current price, so I'm just going to do it because it's the most convenient for me here. But at the same time, I look around and I'm like, this is driving out again, sort of like the veterinarian thing, the corner store barbershop, where it was just the solo practitioner or two guys with two chairs, and it's where, it's kind of a hub of the community, and you can go get well, in the old days, a $12 haircut. Nowadays, I probably can't get your haircut anywhere for under 30, I imagine. But it was just sort of the cheap but personal and part of the town fabric part. Now it's the sort of corporate, like I said, haircut as a subscription service, super impersonal. I don't know. Not only with the malinvestment, economic part of it, Michael, I feel like we're just kind of losing part of what enriched our social fabric through all this stuff.
But those are choices we make too. And I'm going to give some free advertising here. There's a hardware store called Stroh right around the corner, and they are 10, 20, 30% more than Home Depot. But when I go in there, it's very personal. They help you. Everyone there can help you, or they know someone that can. It's not just, oh, it's an aisle six, but it's, oh, you're going to need this. And if you get that, make sure you screw it on this way and that way. And here's what you need to do. And I go there on purpose. A, it's a little closer, but B, I know I'm paying more, but I like supporting them. I like them being in business. Because when I get to Home Depot, I'm always pissed off because no one knows where anything is.
Yeah.
Definitely no one can help me. Like, hey, how am I going to get this onto that? What do I need? No one has a clue, and it's annoying. So we as consumers can elect where and how to spend our money. So I think it's easy to blame other people, but you can go to that place or the hair cuttery, or you can go to, Spiro's. and get your hair cut there, and it may be a little more, and you don't get the TV, but you get some nice conversation, and you feel like your money, you know who your money's going to. So look, and that's not to say I just go to local places. I don't. I go to the big box stores too, and I'm as guilty as anyone else, but those are all decisions we make.
So I totally agree. We every time we open our wallets, we vote with our dollars for the type of solutions that we want to see in the world. So I totally agree, and I've been a big supporter of sustainable produced foods, which cost more but are way better for us nutritionally, but also way better for our soils and our communities and all that type of stuff. So I've made this pitch a lot. Um, but what I am seeing though through this is, yes, we can do that. But the problem is the more of these kind of both big box and private equity backed franchises and stuff like that come into play, it does steal enough people in who are driven just by the bottom line or whatever, that the small independents can't, they don't have enough economic demand to be sustainable anymore, and they go out of business. And that's the thing that I'm really mourning here, which is, yes, we should, as we see new models like that, or the models we like, we should feed them. But this stuff is causing a die-off in a lot of Main Street America that is going to be hard, I think, to recover from.
Right. And that's, we were talking about the 50s. Everything was Main Street America in the 50s. Now we've gone so far away from that. So when you're talking about standard of living, maybe financially we're better off, but we don't have the mom and pop shops lining the street, that the service would be better, or
Right.
the
And are we
food
better
would
off with
be
a cheap
better.
Chinese product that breaks in 3 months versus the more expensive American one made locally that might be around in 50 years, right?
Right, right. So, and you can blame the politicians, but we have made that decision with our wallets, like you said.
Yeah. And so totally agree. There's a big onus on us for that. And Treasury Secretary Scott Bessent, when it was like his first or second month in office, but he said something that really, I was super shocked in a really positive way. And this is back when they were sort of telling us like, hey, things might get rocky for a while. I think they've reversed from that a little bit. But he said, hey, buying cheap crap from China is not an American birthright. And I thought it was really good, kind of like just straight talk, tough love, harsh medicine from a government official. It felt so rare to hear. But he's right in the sense that like we have come to believe that the supreme arbiter is simply price, and that we should be able to get cheapest stuff from wherever it needs to come from to be happy and to run our economy. And that isn't a birthright of ours. B, there's a lot of cost that comes along with it. Part of which is we've learned through the past several years that hey, we're maybe too dependent on countries that aren't our best, don't have our best interests at heart, right?
Mm.
And sometimes resiliency is what's more important. And sometimes to be resilient, you pay a little bit more up front, but it pays off in the long run, right? So
Right.
to your point, I think we just need to, as a culture, say, hey, look, you know what? We should value things other than simply the absolute most rock bottom cheap price. All
Right.
right. Well, look, great discussion as always, Michael. Thank you so much. I really appreciate you again pinch hitting for Lance while he has to take his wife to one of her chemotherapy treatments. Last update from him was things were going as best as could be hoped there. So we'll all collectively keep our fingers crossed and keep making our prayers for her. And just wrapping up here, folks, please, first off, thank Michael for both investing the prep and the time to come on here and fill in Lance's shoes, and show him that appreciation by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. If you didn't watch the conference, the Thoughtful Money Fall online conference this past weekend, don't worry. If you would like to actually watch it still, you can by purchasing the conference replay. To do that, just go to thoughtfulmoney.com/conference. And if you are a premium subscriber to our Substack, look for the code I've been sending you. You can use that to get an additional $50 off of that replay video. And if you are looking to lock in our spring conference price at a 0% inflation rate, meaning the same price we just did the fall conference at, because we don't know yet whether we're going to be able to keep the price the same or if we're going to have to raise it next year. You can buy it at today's price over at thoughtfulmoney.com/2026. And again, you can also use your code that I've sent you to get $50 off of that price for the spring conference too. And then lastly, if you would like to get some help in figuring out how to navigate your portfolio for the road ahead, especially if it plays out the way that Michael thinks it may, then highly recommend most people watching this video get that help from a good professional financial advisor. Importantly, one that takes into account the macro issues that we talk about here. If you've got a good one who's doing that for you, well, stick with them. Don't mess with success. But if you don't, or you'd like a second opinion from one who doesn't meet that criteria, maybe even Michael and Lance and their team there at Real Investment Advice, then consider scheduling a discussion with these firms. To do that, just fill out the short form at thoughtfulmoney.com. These consultations are free. There's no expectation to work with these firms. It's just a service they offer to be as helpful to many people as possible. Michael, again, my friend, thanks so much. Really appreciate it. I'm sure you'll be pinch hitting a bit more in the future. Can't wait to see what the world has cooked up for us by the next time you're on.
Sounds great. Looking forward to it, Adam.
All right. And everybody else, thanks so much for watching.
I think we'll see new highs in the next 12 months. And I think we'll retest the highs in the next 6 months. So retesting meaning 50 in the next 6, and then breaking out to new highs in the next 12 months. I could be wrong on the timing, but it certainly seems like that's a very intriguing timeline to follow because of the volume we're seeing of purchases post days of declines. We're seeing clearly the outperformance of silver even when gold is falling, and the reaction that even technical analysts that tend to push these movements from a momentum standpoint are beginning to see the probably greatest cup and handle we've seen in history that is still not, have not ended. We still need to see the other side of that handle really break out.
The silver will retest its previous high of around $50 within the next 6 months and likely break out to new record highs within a year. While the exact timing could vary, the outlook is supported by strong buying activity on market dips, silver's resilience compared to gold, and technical patterns, particularly what may be the largest cup and handle formation ever observed, that suggests a powerful breakout is still ahead. Tavi Costa is a macro investor and portfolio manager at Crescat Capital, best known for his deep research on commodities, precious metals, and global macro trends. The classic cup and handle pattern starts with a massive price surge, like what happened in silver during the 1970s, followed by a peak in the 1980s and then a long period of decline and loss of confidence that lasted about 20 years. That long downturn marked the bottom of the market, and by the early 2000s, silver began another cycle, eventually retesting its previous highs. Each time prices return to those old highs, selling pressure often increases because investors fear a repeat of the past. However, the recent decline in silver wasn't as deep as the crash of the 1980s, and the industry has recovered more steadily this time. Now, silver is once again pushing toward its historic $50 peak, and with so much momentum behind it, many believe a breakout is coming. In markets, there's a saying that there's no such thing as triple tops, suggesting silver won't stall out again, but instead move higher once it clears resistance. For investors, the takeaway is clear: prepare for the possibility of much higher silver prices, but the broader setup strongly favors silver's long-term upside. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
If you think of how a cup and handle is formed, it initiates with a large movement that is usually unprecedented, which happened in the 70s, and then peaked in the 80s. And then you have this complete loss of faith and a peak of a bubble. And that goes on for a long time, 20, 30 years, 20 years or so, of which was the case until the late 90s. And after we saw that, that was the very bottom of that market. So we went all the way up and created the beginning of another cycle, which was the early 2000s, until we retested the highs of the prior bubble. And so investors look at those two things and say, well, that looks like, that same issue we had in the past. And so the selling becomes more pronounced at those levels. And it's normal to see that type of pressure creating another long-term decline. The difference is that this decline wasn't, although it was very difficult for those invested in this industry. I wasn't involved with the industry personally, but I clearly that decline really shaped the industry in a big way as well. But it wasn't as deep and steep as we saw in the 80s. So that decline, although marked, in a huge way, the history of silver, it was definitely, much easier to stomach relative to the 80s. And so now, we're seeing another movement to push again to that same level that we saw the peak of the bubble in prior times. The thing is, there's so much energy behind this to see the price breaking out. There's a joke that we say in markets, there's no such thing as triple tops. And there we have it, approaching a triple top. There's going to be maybe a moment where we hit that 50, and nobody knows if that's going to be the case. But there's a very high likelihood that we may hit the 50 and people will say, well, that might be it. We might hit a peak here. I don't think that will be the case because cup and handles break out. And so we may see a short-term movement. This is why I said 6 months to get a 50, 12 months to break it through it. But I do think, regardless of the timing of how this whole thing will resolve, I think the resolution is we're going to see much higher prices. So if you're investing in the space and you have that view, you can apply that in markets. Look at if you're running a mining company, you can see this. All right, well, there's a clear path that we may see a break of silver prices. What is my biggest risk here? One, that I'm wrong. You could always be wrong. But two, how do I secure my margin? Because that's the biggest thing. That's your biggest treasury. So this is why I'm urging people in the space to say, protect your margin because your biggest risk right now is energy. It's not the stock market, it's energy. And in some cases, investors may have issues with maybe labor costs and others. And so it depends on the structure of your cost. But usually energy is about 30% of your cost, particularly coming from open pit projects. And so, yeah, that's the way I'm envisioning this whole thing. And as an investor, if you are in that side of the market, then, act accordingly. Think about companies that will be in a great position if prices reach those levels and plan for that, really try to plan for it. And yeah, that's the way I invest. That's the way I do my things. And, if things change and the plans change and there's another pandemic or something along those lines come and we have a major change in markets, sure, I'm allowed to change my views. But having a plan is important. And so that's how I'm trying to approach this.
Tavi Costa explains that gold has led precious metals and hard assets for a while, but markets often rotate leadership between commodities. Although gold functions more like a currency, it has acted as a commodity and signaled the start of a long-term bull cycle in the sector. Recently, however, other metals and related assets have begun outperforming gold. Tavi relates this situation to April 21st. Gold has moved mostly sideways, while the TSX Venture, heavily weighted toward precious metals, rose over 30%, and silver gained double digits. This shows investors are becoming more comfortable with gold and are now moving further along the risk curve, seeking higher returns in less liquid assets like silver and mining stocks. The trend suggests we're entering a phase where other metals catch up to and potentially outperform gold. Moreover, Tavi exposes that we're in what could be called a golden age of mining, as profit margins are exceptionally strong with gold and silver prices far above production costs. However, this may not last forever, so miners should hedge energy costs to lock in profitability. At the same time, the industry faces a major challenge. Reserves are being depleted, few new discoveries are coming online, and exploration budgets remain low, leaving most major miners with very limited replacement reserves. Now, let's just dive into the interview.
Yeah, I do. I think that would be a normal behavior of the metal. We've had, gold really leading the pack of precious metals and hard assets for some time now here, especially in the commodity space. And I think investors that understand the commodities, sector very well will appreciate the fact that there is a rotational dynamic that usually happens where a commodity will take the lead versus another at certain times. And I'm not here to claim that gold is necessarily a commodity. I do view it as a currency, but it acts as a commodity in that case. And I think gold has been signaling that for some time now that we've seen finally the beginning of a long-term cycle in this whole industry. And we're now what seems to be the beginning of other metals and other derivatives of the gold-related trade or investment starting to outperform gold itself. If you look at the gold price all the way back to just April 21st, when right after the whole situation with tariffs and so forth, the Liberation Days, which happened in the 7th, but gold really peaked in the 21st. We've seen gold basically go sideways. And at the same time, we saw the TSX Venture, which marks a lot of especially if you look into the subgroup of precious metals, that whole space was up about 30+% during the same time that gold was basically flat. So, certainly there has been an exercise that I called of acceptance of risk occurring across investors that are looking for the next thing after gold. That doesn't mean gold is going to go away as a trade, but it means that investors are so comfortable with the gold idea that they're starting to go down or go up on the risk curve and go down on the liquidity curve in order to hopefully capture more returns. And I do think that's going to be the case. And so, I'm paying attention to that because silver has also outperformed gold since, silver's up double digits since gold has been basically flat and down, in fact, since April 21st. So all these things are really interesting. And I think that's the beginning of other metals catching up to gold prices finally. We're seeing what I like to call the golden age of mining, mostly because the margins of these companies are just outstanding. And you can see that in many ways, especially looking at the gold to oil ratio, the silver to oil ratio, and obviously looking at the median cost to produce gold today or silver is drastically lower than the actual price of those commodities or those metals. And that's probably, I don't know if that's going to be the case for the long haul, because I do think energy cost is way cheaper than has ever been relative to metals. And so if you're a producer, you definitely want to be making decisions to hedge energy costs if that's a big issue for you as a miner. I think that's a very important point to hopefully miners will take that strategy as an approach to secure some of those margins over the long haul. We certainly have done that with our own mine, San Cristobal, which is the 4th largest silver mine in the world. We have instructed them to, and they have done it, basically hedge their energy costs for the 3 years out. And I do think that that's, eventually we all know so we were talking about political constraints. Let's talk about industry-wide constraints. One of the largest ones certainly is what we have in terms of the depletion of reserves and no new discoveries coming online. If you think about how many development stories are going to be coming online to become producing assets, it's very small. And also, if you look at the exploration budget across most of the major companies and how much they have found in terms of added ounces, and it's also very small. So the replacement reserve is actually very low today across most of the majors.
Silver appears to be on the verge of a historic breakout, supported by strong technical patterns, resilient fundamentals, and a shift in investor appetite from gold toward higher risk, higher reward assets. Mining companies stand to benefit enormously, but only if they manage costs and secure future reserves. For investors, the setup points to a rare opportunity in both silver and quality miners, though timing and risk management remain key. Do you think silver will finally break above its $50 resistance this cycle, or will history repeat with another stall? How should mining companies balance short-term profitability with the urgent need to replace dwindling reserves? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
Both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold. Well, that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, we're not right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay, if you go up ninefold this time, it means you're going to $8,500 gold, because our low is $1,050. Right. So a ninefold move from 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stopping at 8,000 is highly unlikely, but even if you went to 8,000, do a tripling of silver relative gold, silver would be at $240.
In past bull markets, silver traded at 3 to 6% of gold's price versus just over 1% today, highlighting major upside if it reverts to historical norms. While gold reaching $8,500 is only a bullish scenario, at a 3% ratio, silver could be around $240. With rising industrial demand, persistent supply deficits, and mounting global debt pressures, silver is viewed as deeply undervalued, reinforced by the elevated gold-to-silver ratio above 90-1 compared to its long-term 40-70 average. Michael Oliver, veteran market analyst and the founder of Momentum Structural Analysis, highlights that silver is experiencing its largest demand surge in decades, especially in solar, electronics, AI, and defense sectors. Meanwhile, supply is shrinking due to declining mine output and inadequate recycling. MarketWatch describes this as a potential supercycle, with severe supply deficits encouraging a powerful, bullish run. Noting this, Michael Oliver predicts that silver is entering an acceleration phase and could reach $60 to $70 by year-end, surpassing its old highs near $50 from 1980 and 2011. Adjusted for money supply growth and inflation, silver would need to be around $200 today to equal those past highs in real terms. They believe this surge will break well beyond those outdated levels. Silver has broken through long-term resistance at $34.90, surging to $38 to $39, its highest in 13 years, signaling an incredible breakout, with technical targets of $41 to $42 and potential for a larger structural rally. While silver has jumped approximately 54% from $24 this year, mining stocks remain undervalued. attracting institutional and ETF inflows. With industrial demand from solar, electronics, AI, and defense rising against tightening supply and reported deficits, the outlook remains strongly bullish. In order to receive fast notifications whenever we release a new video, please like this video, subscribe to our channel, and turn on the notification bell.
Yeah, they've already done that, frankly. Silver had a high back in October of last year at 35. It dropped. Came back up in March of this year, hit 35 again, dropped. In fact, it had a cleansing drop down to 27.50. And then came back up, and in June, it got up above 34 again. Again, not taking out the 35 plus highs. Okay, they were like 35.50 each. But at 34.90 area, we had a major momentum breakout of a structure that said, okay, silver's coming out of this congestion. By congestion, I mean, if you go back to May of last year, silver was 32.70 at a high. You could draw a line sideways through May of this year where it was either side of that level, up and down, but really just net sideways. When it got back to 34.90 in late June, we said, that's it, it's coming out of here. Whoosh, it went up to 39. Now, you know, as typical, the price chart guys like to sell round numbers or just in front of them. So let's risk 40, okay? Okay, and now we're trading either side of 39 right now on the September contract. We think the process has already begun that you were asking about. We think the acceleration phase in silver and the miners. Now, for instance, GDX has gone from a sleepy upside pattern to suddenly it's now up to near its 2011 highs. We expect GDX not to even stop until it clears its 2011 highs, meaning get up in the upper 60s. And same with the miners in general. Silver, we think in this move, in this acceleration phase for it and it relative to gold, is likely by the end of the year to see $60 to $70. Meaning those old antique highs at 50 in 1980 and 2011, which are really sort of jokes. Because one, you were up there very briefly, like days, and back down. And when you do a real valuation, the degradation of the money unit since 1980, the increase in the M2, or since 2011 even, heck, gold would probably have to, silver would have to be $200 now to just match in real value terms those price highs we saw then. So it's catching up. And I think this surge will blow past those, what we call idiot highs. And at that point, what's going to happen? The public's going to say, oh my gosh, I missed this. I got to be in it. And so I think that's when you're going to see an onrush, fairly fresh, of money moving out of the doubting stock market into, hey, I missed this. I got to be in it. The gold, silver miners, and silver. And that's when you get this gush effect. The wet bar soap effect, you know, where everybody's grabbing it, it goes up. This is not unusual in markets anyway, but especially in these situations, I think I think we're in process right now, in other words.
So when we consider that type of move, Michael, do you see this as more of a different type of new high? As you said, this was kind of a silly joke of a high, you know, up to $50 and instantly back down. Do you see this as a possibility of being a more sustained type of new price level for these metals? Yeah, and both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold. Well, that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, you know, we're not right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay, if you go up ninefold this time, it means you're going to $8,500 gold because our low is $1,050. Right. So a ninefold move in 2015 to, you know, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis.
So stopping at 8,000 is highly unlikely. But even if you went to 8,000, do a tripling of silver relatively gold, silver would be at $240. Is that about right? So it's the point being, when we go up there this time, also the events in the world, and in the street events, the academic notions about what works, what doesn't.
Michael also compares silver with gold in a way that he points out that silver has a history of outperforming gold during strong rallies, like in 2020, when silver nearly doubled while gold rose only about 25 to 30%. Recently, the silver-to-gold ratio fell below 1%, meaning silver was priced at just 1% of gold's value, a rare level that historically signals a strong buying opportunity. Over the past few months, silver has started to outperform again, while gold has mostly moved sideways, showing strength that suggests it's entering a new phase of outperformance. Looking at long-term trends, silver often reaches around 2% of gold's price, so doubling in relative value, while gold itself looks ready to resume its upward move soon. The best opportunities right now appear to be in silver and mining stocks, with gold likely to follow later.
That's the growth. Also, state and local government was a huge component the last time around. And usually government hiring has been a huge thing for the last 6 months. And when you look at things like transportation or factory, flat to dead, if not declining. But the overall number looks great, okay? So it's all illusory stuff. And he finally admitted to it. That's great. So anyway.
So, Michael, we've talked a lot about gold and its reaction here. Do you think we should be thinking any differently about silver's reaction, despite the setup for gold with the interest rates and the equity markets that we've already touched on?
I think silver is participating with gold. It vastly outpaced gold in that 2020 rally. Silver almost doubled in price, whereas gold went up about $500, which is like 25%, 30% rally. Silver doubled. So into mid-2020, silver had outperformed gold on a percentage basis. But from 2020 through, the recent low, the silver spread went from like 1.5% of the price of gold down to 1% of the price of gold, even got below 1%. We divide an ounce into ounce and you find it was 1% of the price of gold. If you go back through 50 years of history and look at that spread relationship, you'll see that when you get down to the 1% level, it's time to buy silver. Okay, it's meaning it's dirt cheap. It's not going to go to zero versus gold. Okay. But then the technicals turned, and so over the last 4 or 5 months, you've seen silver outperform gold. Like, for example, back in April, gold hit 3,500. It's gone sideways, April, May, June, July, now, August. 4.5 months of comatose but steady sideways. They keep trying to sell it, but then go down. But it also doesn't go up. So it's had a sideways correction, which is, by the way, not the way gold ever tops. Okay. During that time, silver's gone up sharply. Okay. We assess technically that silver's now at a point where it's going to outperform gold fairly dramatically. If you go back over 50 years and look at that same spread, you'll see the number of years it got up to at least 2% of the price of gold was like 21 of those 50 years. So it's not abnormal at all. So from the recent low of 1% to 2%, meaning silver could double in relative value to gold, probably over the next year. Wouldn't be surprising me by the end of the year even. Same is true with the gold and silver miners. They're back into outperform mode versus gold. And if you'll look at gold sideways since April, look what GDX has done, vertical. Okay. So I think those parts of the monetary complex are the place to be right now. Silver, the gold and silver miners. Gold will re-engage, and I think it's going to re-engage probably later this month or next to the upside, where people say, oh, it's awake again. But silver and the miners will be the place to be.
Silver appears to be entering a powerful new bull phase, supported by historic undervaluation relative to gold, record industrial demand, tightening supply, and strong technical momentum. With prices breaking out to multi-year highs and miners still undervalued, analysts like Michael Oliver see silver leading the precious metals complex, potentially reaching levels far beyond its old peaks. This makes silver and mining stocks some of the most compelling opportunities in today's markets. If silver truly enters a super cycle, how high could prices realistically go beyond the $60 to $70 near-term targets? With mining stocks still undervalued, should investors focus more on physical silver or silver equities to capture the upside? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
Japanese yen is one of the worst performing currencies versus gold, which in my book is inflation. I mean, not that gold isn't breaking out already, but I think silver will accelerate. And like Phil said, for people who haven't bought gold, I guess silver will be the alternative.
For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like that, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock.
25th of September, the consultation period over whether silver should be a strategic mineral in the United States will finish. They'll have to start building a silver stockpile. And we don't know how big that stockpile will be. Obviously, in the past, it was 2.1 billion ton. If there's a disruption in the supply from Mexico, which is where they're getting most of their silver from.
One of the worst currencies in relation to gold has been the Japanese yen, underscoring the growing pressures of inflation. Silver is predicted to rise quickly as a substitute for gold for those who missed it, even if gold is already starting to break out. By September 25th, the United States must decide whether to designate silver as a strategic resource. The government would have to accumulate 2.1 billion ounces, which is almost 3 years' worth of mine supplies, if it were authorized. Since Mexico supplies a large portion of America's silver, any disruption there might have a significant effect on the U.S. sector. Experts estimate that there is a 4% chance of such a situation. Mario Inequality, a famous market strategist, and Phil Lowe, a sharp macroeconomic commentator, both highlight that since April, the Dow-to-gold ratio has fallen precipitously, and it currently exhibits trends reminiscent of those seen in 2007 before the financial catastrophe. Long-term charts indicate otherwise, despite some people's concerns that a liquidity event may put pressure on gold and miners. It's evident that the trend is strong because banks like Goldman Sachs are now predicting that gold will reach $4,000 by mid-2026. While silver targets are already almost reached. The wider breakthrough indicates that gold's bull market is well established, even in the face of possible short-term pullbacks. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
This one here is the Dow gold ratio, and we dropped quite a bit in April when we had that beginning of April, and then it's being consolidated, and now it's breaking down, and it looks a little similar to this, and this was in 2007 before the great financial crisis, but I mean, we'll have to see anyway.
One thing I may, because we were just discussing Weimar, I do want to stress that Weimar was a very unique situation because the Entente powers were not letting Germany default. They said, you cannot default, you have to give us gold. And that's what stretched Weimar out to 2 years. I want to reassure the viewers, like, I think this will be over in 3 to 6 months once it really gets going. It's going to be brutal. It'll be as brutal as Weimar, but it'll be a lot shorter.
Yeah, but in Weimar, it started taking off. The hyperinflation really picked up in the summer of 2022, 1922, and by the
Yeah,
1923 it was over. So it was about 18 months. Uh,
yeah.
and
I
this is
think this will be about 3 months. I
yeah.
think they'll once they start losing control of food prices, I think they'll revalue to gold.
And I thought commodities were going to start a bull market in the early 2020s, only because bonds, I thought were going to start a bear market, and I thought hard assets will benefit in relative terms. But we see now that banks like Goldman Sachs, who usually just push paper and derivatives, they're actually telling their clients to diversify into commodities. And they even, I think they said that they expect gold well above 4,000 by mid 2026 if the Fed's independence is damaged. So I thought that was interesting.
Yeah, I see that. Well above 4,000 by mid-2026 in the middle of your page, Mario. I see that.
Yeah, it's here. Yeah, right there.
Their calls just follow the market.
Yeah. The other couple of weeks ago, Bank of America, which is another bullion bank, they said, "Oh, we're bullish silver. We see silver at $42 by the end of 2026." And I thought, that's not bullish. We're almost at 42 now. So, the bullion banks, I mean, I've been following them since I started following gold in '02. And I mean, now they can't do it anymore because gold is in a massive bull market. But for example, a few years ago, if gold was like 1,500, they'd say, "Oh, in the next few years, we expect gold to revert back to 1,000," and like so on and so forth. But now, they're saying they're bullish, but I think they're not bullish enough. And one of the reasons is these couple of charts here, and I'm going to bring them up. First one is a bit more short term, and this line here, we're going to see in the longer term chart. I think it's really important, and it was around 2,700, this line, and that's why I think we saw this pullback, in the retest, and now as well. I mean, we've broken out of this pennant or symmetrical triangle, and it's really taken off, and there's nothing like above here. So that's very bullish. I'm not saying we won't see any corrections, but and then this one is the same chart, but really long term. And this is why that 2,700, in my opinion, was so important. And I was waiting for that
Wait,
test.
Mario, can you flip back to the other one so I can see
Yeah.
the difference for a second? Okay, yeah, and then go to the forward. Okay, okay.
So this is from the high in 1980 to the high in 2011. That's where that 2,700, when we were breaking out here, I thought we might see resistance at 2,700. I mean, we didn't initially because it went up quite a bit, and then I'm not sure, it went 2,900 or something, and then it broke back down. I think it was after the Trump won the election. But now, I mean, we're really taking off, and a lot of people don't look at these long-term charts, and this is why I think yeah, people are concerned about a liquidity event.
Rafi Farber, known as the Endgame Investor, in an interview with Phil Lowe, Mario Ineco, and Clive Thompson, points out that China is injecting funds into its banking system through what it calls reverse repos, essentially providing liquidity much like Western repos. The government is trying to reflate its struggling economy, which faces weak exports to the US and a collapsing property market where apartments, once the main savings vehicle, are now oversupplied and losing value. This has left many Chinese households cautious about spending. While some argue China could rise as a global power, others believe its fate is tied to the West. If US consumers are broke, Chinese producers suffer too. On top of this, China holds vast US dollar reserves that may lose value, and even its large gold stockpile could backfire by pushing domestic prices higher and undermining exports. In short, both China and the West are trapped in the same fragile global system, and neither has outsmarted the other. Let's revert back to the
This is the case. I think when China refers to reverse repo, they mean what we would mean by repo. I think they just got their terms.
Yeah, they are buying. I think they're buying the government bonds from the banking system and injecting cash into the banks. I
Yeah,
think
so
US is the other
that's
way
what we would
around.
call repo. In
Yeah,
China they
yeah,
call it reverse repo.
yeah,
Whatever. It means they're injecting cash into the banking
yeah,
system.
yeah.
I didn't hear about this. China is they're like on a different wavelength because their interest rates are going down and down and down, and the West interest rates are going up and up and up. Um, I still think that when the West falls, China falls with it because they are the producers and we are the consumers. So if the consumers fall, the producers fall too. Like if you lose your customers, you lose your income. Or if the currency collapses in which you're getting your income, then you lose your income also. Uh, why China would be injecting cash now? I mean, we know. I mean, the place is very opaque. It's still communist, except for the special economic zones that they allow freedom in, so they can supply the West with a bunch of stuff, so they can stack more dollars. But China's economy has been so fake for so long, and they still have these ghost towns and this whole real estate bubble throughout the whole country, and it's still like a very corrupt, disgusting regime. I mean, we're not allowed we don't really say that because the West gets most of its stuff from China, but that's still the reality, and it's gonna have to go.
Not very different though from our regimes.
That's true. No, I guess in the way it functions, no, but at least I mean the West still has an idea of individual liberty, whereas I don't think the Chinese see that as a value at all, other than maybe a temporary expedient. There's still a feeling in the West that individual liberty is a good thing in and of itself. In China, that was never there.
Things, the Chinese injection of funds, or
I mean, they want to reflate the economy. China's suffering obviously from the slowdown in sales to America on the one hand, and secondly, the way of saving traditionally in China has been by buying apartments. So many Chinese people bought apartments, and now suddenly they're finding that the bottom's fallen out of the market because there's far more apartments or houses, if you like, than there are people to occupy it, and the population is not rising anymore. So and a lot of building companies have left these blocks of apartments which they're building and that people have paid for. They're half empty. So suddenly everybody is now drawing in their horns saying, oh my God, my traditional form of saving isn't working, and they're not willing to spend money on things. And so the Chinese government definitely has to reflate the economy. I think we're going to see more of that. I think that's just a first step, and we'll probably see more money thrown at the economy sooner or later.
Oh, yeah, there's a lot of people who think that China is somehow eating our lunch, that they've somehow outsmarted us, and I think your friend King Kong, Eric Young, is talking about the rest of the century is going to be the Chinese century where China's going to move to the forefront.
yeah,
I don't
think
think
Jim
that's true
Rogers
at
said
all.
that too, didn't he? Jim Rogers, I think, yeah.
Yeah, I don't think that's true at all. I think we're going to see. I mean, we're all going to go down together. It's not like we're going to do fine and they're going to collapse. They are holding enormous amounts of American dollars. We took all their stuff and we gave them dollars, which we're going to default on, and so all the people holding dollars are going to be completely broke over there. Not to mention they have overbuilt their industry, and maybe some people say, well, it's better to be overbuilt than underbuilt, but they're going to have a bunch of factories with absolutely no one to sell to because we are broke. America's broke, so we can't buy any more Chinese stuff, and there's not going to be anything in China to sell. There's not going to be anyone to buy. They can maybe sell domestically to their gold holders, and gold and silver holders, but most of the Chinese are also broke because instead of going to gold, they bought a bunch of real estate. So to say that if you think the Communist Party of China is somehow doing better than us, then we should not have a free society. Then communism works, right? If you think communism works, if you think China's beating us, then that means communism works, and maybe we enjoy our personal liberties better, but communism is now a better state. And
Well, I didn't say that.
Yeah.
I'm just.
I know you didn't. There are Chinese.
I'm
Chinese
just reporting on the injection of funds But
Yeah, absolutely.
I think China, though, has a lot more gold than they tell us publicly. They've got a lot more than 2.3 thousand tons.
That's also not a good, that's not necessarily a good thing, because
Yeah.
gold has, having lots of gold in a system. I'm not talking about a person, because people mistake what I'm trying to say. For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like that, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock, because we will want to sell them stuff to get their gold. Now, what's that going to do to Chinese industry? It's going to collapse it. Chinese export-based industry, when prices are sky high in China, so they have all kinds of problems on their end too. It's not like they are not outsmarting us. They're not outsmarting the system. The system is stealing from everybody around the entire world. And we Americans are sitting in drowning in debt, and in China they're slaving away for American debt that's not worth anything. So they're slaving away for nothing.
Both the US and China face mounting economic pressures. Whether it's America's debt-driven push toward hard assets like gold and silver, or China's struggle to sustain growth amid a real estate bust and reliance on weakening US demand. Precious metals are increasingly seen as safe havens in this fragile global system, and their rising momentum underscores a deeper shift away from trust in paper assets. Could silver's potential designation as a strategic resource accelerate its price far beyond current projections? If China reveals its true gold reserves, would that stabilize its economy or trigger more volatility worldwide? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.